expecting an eventual slowdown. But it's not here yet.
We're not seeing the economy going over a cliff, and this is exactly the time that the Fed needs to be moving quickly.
We can see areas of the economy where they're very successful and areas where they need to continue.
They have to keep on raising rates. I just think we have to be careful about the level of rates that we get to.
There is this path to a soft landing. I don't see why people think it's such an elusive thing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. It's a Monday. It's 2 days before CPI Wednesday. We're going to beat you to death with that all week here. Kaylee Lyons in for Jonathan Ferro. He's off for one day. It's Howells for one day. Lisa, what an extraordinary weekend. Legislation in Washington. Greg Valliere fell off his chair.
It really was a game changer for a lot of people, both with respect to some of the proposals and also just what it does heading into the midterms, especially as I was driving down the highway and I saw that gas prices in some places under $4 a gallon after being up to $5. You pair that with a legislative win and suddenly people are gaming out potentially a different output from this midterm election cycle.
Off the bang-up jobs report, then what it's really about, Lisa, is the analysis of top-line inflation, gas coming down, or core inflation. Let's be clear, the Bloomberg survey lifts core inflation.
This is the big conundrum right now. You have on one hand that headline CPI that's going to roll over and those gas prices that are coming down. How much does that fuel consumer sentiment? On the other hand, that core, because it is sticky, what does that mean about how far the Fed has to go? You know, on Friday, we got this jobs report. Everyone's cheering the fact that it looks unlikely that we're going to have a recession. People are not counting in a Volckerized Federal Reserve, which could be also the result.
A lot of their publishing over the weekend, and it's good to start with David Sowerby. He'll be with us in a moment with his optimism on participating in ownership of stocks. Kaylee, an open question to you with your weekend reading. Where is the focus, bonds or stocks?
That's a really good question, Tom. I think primarily a lot of the action has been in the bond market in recent days. Yes, you've had the stock rally that really is continuing in a fashion today that it didn't necessarily on Friday, but the bond market has been absolutely confounding, Tom, as I look at a yield curve inverted by 41 basis points on the 2s10 spreads. Obviously, you have a repricing in the short end as there is an expectation, a greater expectation that the Fed is going to move 75 basis points in September. September is still a long way away. We have a lot of data before that. And of course, CPI on Wednesday, one of the more crucial points.
Well said. I really, really agree with that folks, we're miles away from a belief on September and certainly into the November meeting as well. I'm going to do the data check right now. Kaylee, help me out here. I'm going to go to Priya Miser's number, the 2s10 spread. And I'm sorry, Kaylee, it's extraordinary, a negative 42 basis points, the call of the summer from the strategists at TD Securities, and that rapid inversion. You know, I love what someone said, warp speed inversion is what we're seeing now. I think it was Ben Emmons at Coynet. Kaylee, what do you see in the data?
Yeah, well, the yield curve most inverted since the year 2000, Tom, is certainly remarkable. What's interesting is you're starting to see a bit of resilience showing up in the equity market. Futures in positive territory by 9.5 points this morning. How much can that stick realistically, Tom, if we are talking about a Federal Reserve that is going to be more hawkish and that pivot that the equity market has been expecting isn't necessarily going to come soon? And of course, interesting, you're seeing yields actually moving a bit lower on the day. We're sub 280 on the 10-year.
Peter Scheer with us later, folks. That'll be must-watch for Global Wall Street as well. The governor you don't know, the Fed governor, Michelle Bowman, who's the community bank governor, maybe less visible than the others, but nevertheless important. She is in search of unambiguous evidence that inflation's going down. We start with an unambiguous Monday brief. Here's Lisa.
Well, I'll give you an unambiguous morning tidbit. I came in this morning and I looked at what to expect today, and I said, I'm going to do a Tom Keene. It is going to be the beginning of the week on Wednesday, so let's start there. Wednesday, we get U.S. July CPI, and this really will be the issue. Core CPI, Tom, you nailed it. Oh, thanks. I know you're going to mock me for it later, but what you can see is bouncing around, surge up, and we're a lot higher than we have been historically in terms of the consumer price index. If you start to see that core continue to tick up, how much does that indicate that the Federal Reserve has so much more to do and really has to fight this sort of roving inflation that is sticky and goes well beyond some of the transitory issues of gas and food? Thursday, we get the U.S. July PPI, and the reason why this is particularly compelling is these are the prices that factories and manufacturers pay. How much does that continue to climb and climb at an exceeding pace than CPI? This goes into the whole issue of Morgan Stanley's Mike Wilson saying you're going to see profit margins crimped. You are seeing these prices increase at a faster pace than consumer prices. That cannot continue for that much longer without at least seeing profit margins squeezed or a continuation of CPI. And on Friday, we gauge sentiment. It should improve, especially considering the fact that gas prices have gone down. And the University of Michigan Sentiment Survey tends to reflect that aspect. However, just to give you a sense of where we are, we have been at the lowest consumer confidence in history in data going back to the 1970s. How much can we revive, and what does this really tell us about where the sentiment is going at a time when people are very concerned about inevitability
and what's
of a
amazing
recession?
here, for those of you on radio, it's an oscillating chart back 40 years, and man, we plunge here in consumer sentiment, Lisa, and it really speaks to the two Americas out there after the bang-up jobs report, 560,000 plus formed with revisions.
And this has been the issue. You have two Americas where you have the people on the upper end continuing to spend, the consumer discretionary companies that cater to them doing just fine. And then you have people who are paycheck to paycheck with a real paycheck that is shrinking at a rapid pace. How do they deal with the outlook right now of this roving inflation moving from zone to zone?
Futures up 12, the VIX under a solid 22. That's impressive, 21.80. Let me go to the draw up that we're seeing right now. Let's frame it out. David Sowerby loaded the boat in the bottom, in the middle of June, I should say, with a draw up of 13% SPX, a Dow a little less, up 10%. And the NASDAQ Sowerby surge up 19%, says all there is. He is the great optimist from the Midwest. David Sowerby joins us with Ancora. David, you've always been in the market. You believe you have to participate in American equities to prosper. Are you fully invested now, or sort of a Sowerby halfway invested?
More than halfway, Tom. I didn't load up the boat in mid-June, but I simply thought valuations were more attractive. Sentiment was very bearish. Those are usually very good signs. When you talk to companies anecdotally, whether it's at a conference or on an earnings call, I thought the tone of the message was better than what Wall Street was pricing the stock, and companies thought the same thing, that their valuation was attractive. And it was a good time to be a net buyer, but I didn't load the boat, but I'm more fully invested today.
The theme over the weekend research, David, which goes to your work, is that if inflation comes down, that assumes nominal GDP comes down, and the fuel portion, the inflation portion of corporate revenues becomes a little less. Is that something to study and be afraid of?
No, I think the main point you should study is that it seems like the magic line is 4% for inflation. When inflation rates are less than 4%, stocks are your best hedge against inflation in the long term. When inflation is above 4%, it's problematic. We need to get there. The Fed needs to still do more. This inflation is and always will be simply a monetary event. All the stimulus that the Fed and the fiscal authorities put in, the Fed needs to do more work. I think the stock market will embrace it, and we'll still get nearly double-digit returns over the next 2 years.
David, you talked a little bit in some of your research about how to treat the legislation that was passed over the weekend by Senate Democrats. How much does that change the landscape when it comes to companies buying back their shares, when it comes to tax policy and issues that move beyond monetary aspects?
Lisa, it simply in policy terms gets a letter grade D, maybe a letter grade F. I own 32 stocks in the mutual fund I co-manage. I'm buying these companies because I think they're good allocators of capital with the cash flow they generate. Take two names as an example to criticize the share repurchase tax. Marriott and Wyndham are growing their rooms. That means they're hiring people to build those rooms. They're growing the dividend, and they're buying back shares. And they're deciding how to allocate that capital best in the interest of the shareholder, and to begin to tax share repurchases, I think is simply misguided, because you're hurting the investors like policemen, firemen, laborers that I manage money for. It's simply bad policy.
But could the Inflation Reduction Act actually reduce inflation, David, or you don't buy that?
No, I don't. I think I think it's got to be where the Federal Reserve continues to do what they're doing. They're behind the curve still. Inflation is still by far our biggest problem. It's a tax on consumer purchasing power. I don't know how this bill gets inflation under control, other than if it does be the lever that ultimately tips us into a recession. Maybe that reduces inflation on the margin, but it's got to start and end with the Federal Reserve on money supply.
You're just crushing it this morning, David. Is it a bill that can be harmless and that is just political legislation before the midterm elections?
I don't think harmless, Tom. I think on the margin it hurts our ability to grow and to compete. We've already stimulated the economy nearly 40% since March of 2020 with the monetary and the fiscal stimulus. Why spend even more? Why tax even more? U.S. tax rates are now less competitive to our foreign competition. I don't think that's the solution if we want to think about good profit growth, good job growth, and it's showing up in good returns for investors in the equity market.
David Sarby, thank you so much for the brief with Ancora this morning. We didn't even get to mid-cap, small-cap, which is his wheelhouse. We'll do that another time. You know, Lisa, I look at the markets here and the silence here of a middle of August in the heat of New York, and that is how many people, including me, missed the mid-June lift in equities.
Yeah, what is it?
Silence is pregnant.
13% gain for the S&P since the low that we saw in June. It has been an incredible rally that has been relatively silent because nobody believes it, right? How many people actually are going to believe in it after it continues to be sustained versus continue to push back and say people need to continue to reduce their earnings profits, their profit margins, and that has been the tone from Wall Street. Well, at least for now.
We've got to see here. We didn't even mention oil here, nicely under that $124 level. How about American oil, $88.26 per barrel, down 75 cents. That's interesting to see that really tilt towards $80 this week would be huge. Surprise. Gold under $1,800, down $17.94. In the 7 o'clock hour, Peter Shears. Stay with us on radio and television. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Senate has passed a landmark tax, climate and healthcare bill, giving President Biden a victory on his domestic agenda. Still, the measure is a shadow of the $10 trillion plan that Progressive had hoped for more than a year ago. The bill now goes to the House, where the Democratic majority is expected to pass it on Friday. And a surprise change at the top of private equity giant Carlyle Group. CEO Ki-Sung Lee has stepped down. Lee's 5-year employment contract was due to expire at the end of the year. Bloomberg's learned that Lee and Carlyle's board had clashed over the contract in recent discussions. The firm's co-founder, Bill Conway, will step in as interim CEO. Hong Kong has reduced the amount of time travelers entering the city must spend in a hotel quarantine from 7 days to 3. That is greater than the expected easing of its strict travel curbs. But Hong Kong is still an outlier in a world that's mostly reverted to pre-pandemic movement. And the trade surplus in China hit another record in July, going over $100 billion. Exports rose a better than expected 18% from a year ago. That's good news for the world's second largest economy. Still, economists warn that the export surge probably won't last forever. And SoftBank has reported a record $23.4 billion quarterly loss. The sell-off in global tech stocks continued to hammer its Vision Fund portfolio of investments such as Uber. Meanwhile, SoftBank has begun talks to sell its assets manager, Fortress Investment Group. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Inflation Reduction Act. This Senate Democratic majority has achieved what countless others have come to Washington promising to do, but ultimately failed to deliver. And I am really confident that the Inflation Reduction Act will endure as one of the defining feats of the 21st century.
He's the senator from Brooklyn, Chuck Schumer there, of course, Senate Majority Leader, taking a victory lap after a marathon night, full Bloomberg disclosure. Our Steve Dennis falling asleep at Capitol Hill during the all-nighter. Someone that knows an all-nighter, well, that could be Jack Fitzpatrick. Let's get right to it with Kaylee Lyons and Lisa Abramowicz this morning. Jack Fitzpatrick knows all-nighters from Memorial Union at Arizona State University, where he pulled off a few of those. Jack, let's just start with a basic idea. Is this any way to run a country? Why are we doing something so childish as all-nighters to pass important legislation?
If you ask senators, even the ones who take advantage of that process, the whole vote-a-rama process is not something anybody specifically came up with as a good idea. It's something they all kind of hate, but now that it's part of the process, they use it. It does speak to, this goes through the whole budget reconciliation, arcane procedure of there are certain things they can pass in the Senate with a simple majority. It's based on a 1974 law that wasn't really made for that purpose, but it's been repurposed for that. And so when you see them do dozens of amendment votes, kind of to torture each other in an all-nighter, it really is a sign of the way the Senate rules have been twisted over the years, and it's not something anybody really endorses. It's just how it is.
So let's talk about what's in the bill. A corporate minimum tax. There also is a tax, a 1% tax on share buybacks. There is also the ability for Medicare to negotiate for drug prices as well as electric car credits. A whole host of different things that Democrats are saying are some of the biggest efforts to tackle global warming that we have done to date. What about what's not in? Any more color into why Kyrsten Sinema removed the carried interest tax? Because that seemed to be a big sticking point.
That was, I don't know if I'd call it a big sticking point, but that's one where she kind of jammed her colleagues, and that was where the last-minute negotiations were, and they just agreed to take it out. At a certain point, those conversations got to the point where she was pushing back, and that did not raise a lot of revenue. There was not a lot of open debate about the merits of that measure on its own, but it was a measure that, of a bill that raises more than $700 billion in revenue over the next decade. That was responsible for about $14 billion. So it wasn't something that was a make or break issue for someone like Senator Manchin, who wanted some deficit reduction. And ultimately, anyone could have sort of vetoed this bill when you have a 50-50 Senate. So when Senator Sinema said that's one thing she wanted out, ultimately people agreed just to get this across the finish line.
If you were listening earlier to David Sowerby, he was on a Money Manager, who was coming out and basically railing against certain components of this bill, in particular some of the excess taxes that are going to be charged to companies. What's the rebuttal by Democrats on why this will not reduce momentum heading into what so many people think is a recession?
For one, the Democrats face a pretty tough challenge of facing worries of a recession, but also inflation. Senator Manchin pushed them as hard as he could towards something that would reduce the deficit in the name of inflation reduction. Now, is it going to have that much of an impact on inflation either way? No, there's not really any reason to believe that. But they had the deficit conversation. And honestly, I think if you hear what President Biden says, he typically says, look, if you're on Wall Street, you're doing fairly well under this administration. Democrats have been talking about increasing taxes on corporations and the highest earners for a long time. They didn't even get everything they wanted, but you should not be shocked that a Democratic administration, Democratic Senate did manage something to increase corporate taxes to some extent.
Well, it may not be a Democratic Senate for much longer. At least that is the thinking heading into the midterms in November, Jack. Does this bill change anything about that calculus?
I'm skeptical this is going to change that much. The economic effects of a bill like this are not something that hits immediately. The priorities that Democrats were going for in climate spending, that kind of thing, is a much longer-term issue. You're seeing the polls show that voters are concerned about the state of the economy right now, how inflation has affected them. This doesn't do that much in the short term. It could be a long-term major accomplishment that the Biden administration administration ends up being very proud of, big picture. But in a matter of months between now and the midterms, this is not the kind of thing that would have a massive effect.
Jack, go further than where Kayleigh was there on the first Tuesday of November. If the Republicans take the House, if the Republicans eke out a 50-50 VP or whatever majority of the Senate, can they reverse parts or all of this legislation?
It would be very difficult to reverse this. I mean, talking about a tax bill, the Republicans want the trifecta. They want to win the House, Senate, and White House, and then use this same budget procedure to get their own legislation across the floor, which we've seen is very difficult. If they win in the midterms, House and or Senate, a lot of that, the effect is going to be they're going to have the committees, they can investigate the oversight kind of stuff that you see from Congress, but they would have a very difficult time reversing this without the presidency.
Get a nap. Get the surveillance nap today. Jets Fitzpatrick with Steve Dennis, I should say, working through the weekend on this important legislation. You know, Lisa, I think it folds into the bond market, and to be honest, Wall Street shrugs aside these kinds of legislation.
In fairness, if you take a look at where this bill is versus the Build Back Better originally, it's about a tenth of the size, give or take, depending on what headline number you want to look at. And a lot of people are looking at underneath the hood and saying, okay, it has some provisions that will actually move the needle perhaps in certain industries, but overall isn't that significant. Terry Haynes came out with something over the weekend basically saying that, you know, this isn't going to exactly shake the world, even though Democrats want to basically advertise it as such. Still, things getting done in Washington is remarkable at a time when this was not on the radar for a lot of people.
And part of the radar is the job formation. Politics is always about jobs. And Kayleigh, we're still in shock over what we observed Friday with the revisions. 500,000 jobs created. What a machine.
Absolutely a blowout report. And it wasn't just about the strength of the labor market, Tom. On the non-farm payrolls figure, wage growth also coming in ahead of expectations, and that in particular may be even more important to the Federal Reserve. Are we going to start looking at wage gains and maybe be more important than just the headline CPI figure? 50%
odds Kayleigh and I don't show up tomorrow. Lisa's announced the week doesn't start till Wednesday. Maybe stay with us, folks, and we'll get a briefing on the way to Wednesday. We can do that with Joyce Chang, Chair, JP Morgan Research. This is Bloomberg. Bloomberg Surveillance, we say good morning to you. Lisa Abramowicz and Tom Keene. John Ferro off till tomorrow, I believe. He's on Halls. One-day Halls for John Ferro. Kayleigh Lines with us this morning. Lisa, let's look at the markets here. Futures up 12. Dow futures up 85. The VIX is solid under 22 to 21.79. Lisa, what do you see in the bond space?
Honestly, just the quiescence is really amazing. Off the highs that we saw on Friday for the two-year yield, which is what I'm watching, 3.2% there. You do see a bid in across the board as people reassess how far the Fed is willing to go. Also dollar weakness, which I think is fascinating at a time when the Fed is going to have to move quickly. How much is this a global pivot to perhaps an aversion to recession talk, or perhaps the U.S. avoiding the worst case scenario?
Lisa and Kayleigh want to talk about the short term here, folks, of course, to get to inflation on Wednesday and then on to the Fed meeting September 1. I've got to talk about the long term, and I can do that with Joyce Chang, Chair of Global Research at JP Morgan, who I really don't like because she put out a 7-page special with a giant Phil Schwagel, Mike Ferroli helping out, Jan Loys and the rest at JP Morgan on the fiscal state of the country. Joyce, I've got to read every word of this report, and it's a path out to 2052. Nobody's talking about this except you. How ugly is it for the nation in our fiscal policy out 30 years?
It's looking pretty ugly, Tom. I mean, we're looking at debt levels that are going to a record level. We're close to 100%, going to 170%, 188%. And if you take a look at our view that 10-year Treasury yields are at 5.5% by the end of the decade, you're well north of 200% of GDP on the debt level. And this is going to raise real questions about fiscal sustainability and the debt trajectory if we see interest rates continue to rise, because the CEO on a 10-year view is using only 3.8% for their Treasury yields Tom, we've got 3.35% by the end of the year.
You've got a great set on this call. The only one that looks tanned and rested, by the way, is Ferroli, and we know, he's leading a cushy life. Let's start with the tanned and rested Ferroli. Do we have the productivity and spirit of this economy, the little growth rate of Joe Stiglitz to grow ourselves out of this conundrum?
Well, you've got to look at productivity for the first half of the year, and it was, as Mike says, atrocious, nearly 7% decline, and we're looking at pretty poor productivity ahead. So you take any metric, Larry Summers, Jason Furman, and you look 10 years out, and on our view, you're at something that looks really unsustainable. And I think this is a conversation that's going to start right now, because the real conversation is still on where are we at in the cycle, and what kind of landing is it? Is it a hard landing or a soft landing? Yes, we're avoiding an imminent recession, but we've got to look at what potential growth is going forward, and we have it at only 1.5% going forward.
All right, Joyce, that's exactly where I wanted to go. If we could put this moment into the trajectory of 30 years, what would it look like? Would it be a pivot point to add more debt ahead of the tsunami, or would it be a pivot point to some sort of higher inflationary regime because of the geopolitical backdrop and the reshoring that you're seeing by a lot of companies?
Well, look, there's the reshoring, the deglobalization, but there's also just poor demographics that we're talking about here. And that's kind of a trend that we're seeing, look, in Europe and China as well. But it's taking potential growth down. And we put that along with, what we see as labor productivity, which is too optimistic in the congressional budget, line. And that really is a key reason why we think the potential growth, the productivity is going to be lower going forward. On top of that, we do see rising treasury yields that are on the horizon. So you take a look at just where we are with the primary deficit, and you're going up to levels that really do point to debt sustainability when we look at the debt service. And you take a look at this, and it's going to just, really with the healthcare spending, that's going to go up because of the demographics.
And this is one reason why a lot of people have the confidence to go into longer-term treasuries, because they say there is no way that this nation, given all the debt, can allow yields to climb for a persistent level because of that debt sustainability. Before getting into the theory of that, I want to go to the moment that we're in, because we're getting a lot of gloom out of Wall Street. A lot of the analytic notes are basically saying people are way too optimistic. The rally doesn't really count. It's a bear market rally. And then you can see it continue to bleed up, the rally gaining steam. What makes for this huge divergence between the tone among the top Wall Street analysts and the tone among traders in the trenches?
Well, look, we've seen bear market rallies like in March, and then the market sold off again. And that's the question, where are we right now? Look, it's just clear that the Fed has a lot more work to do. And I think we're all looking at what's going to come out on Wednesday with the CPI number. Now, Ferroli has the forecast at 8.7%. I mean, that's still going to keep the Fed on high alert. And we have 75 basis points in our forecast for what the Fed has to do, and still 25 basis points in November, December, but a terminal rate, which we were talking, 3.25. Now we think could go up to 3.75% before we really see inflation concerns come down. Now, it's not the cyclical inflation; it's the structural inflation. So it's the wage growth, but also rent inflation, which we have sort of north of 7%. Wage growth is still north of 5%. So that's what we're focused on, in the coming days. A soft landing, I think, is going to be difficult. This immaculate disinflation scenario, I think it's going to be very difficult to see that play out.
Well, and obviously we'll be watching the inflation data on Wednesday, but we'll be viewing it through the lens of the jobs report we got on Friday, which showed an incredibly strong labor market still and escalating wage pressures in the economy. Yet that strong jobs report runs in contrast to some softer data we have seen in other parts. And I'm just wondering if you can glean a consistent message from the economic data we are seeing now.
Look, we have come into this, this part of the cycle with excess savings, and that's actually been a real cushion across developed markets and also in emerging markets. But that excess savings is being, going to weigh down. So on the third quarter of the year, we have just 1% growth for the U.S. That's what we're looking at. But you've had very strong wage growth, the labor market being very strong, also consumers holding in because of this excess savings that they come into the cycle with. But you're going to you'll work through some of that by the end of the year. So I think we also have to look at what's happening outside of the United States. I mean, we've got Europe numbers sliding. China sort of has disappointed on the stimulus. And on top of that, remember that these moves in the month of August are on very, very poor liquidity. I mean, we're heading into some of the worst liquidity months where liquidity is really amplified positively and negatively. So we're at a point in the cycle right now where there's a relief of no imminent recession, but I just think that the liquidity also amplifies these moves. We could see a very choppy market ahead.
Well, Joyce, you mentioned China, and obviously we consider it from an economic standpoint, but there's geopolitical risks to consider as well as we see continued drills happening in and around Taiwan. How do you view just the tension between the U.S. and China, potential decoupling further of the world's two largest economies, and what that ultimately is going to mean for the trajectory of the global economy moving forward?
Look, when we think about decoupling, we have to think about what's desirable and undesirable. And you really have to separate the global manufacturing hub from some of these issues, which are much more about national security and critical infrastructure. But that's pretty tricky. And that's what U.S. Taiwan is showing us when we look at just the concerns about the supply chain, because you have so much of the supply chain really that does move through the Taiwan Straits. And when we look at this and revisit what the precedents are, 1995, 96, when you had these kinds of tensions, you had a financial market sell-off, but not that much impact to the real economy. Now the economies are much more integrated between Taiwan's dependency on Hong Kong and China trade, and also the global supply chain. So I think that this is a tricky moment. I'm not so sure you're going to see these military exercises come to a halt as quickly as people are, hoping will occur.
Joyce, I want to go back to your wonderful fiscal essay. Folks, you can get that from JP Morgan. It's just a really tour de force with Phil Schwagel of CBO. Joyce, a simple question for our listeners on radio, our viewers on TV. Is the United States becoming like France?
Look, what we're doing is really going to affect future generations if there isn't some attention that's paid to the fiscal and the debt trajectory. I mean, we're looking at debt servicing costs that are going to double here, and record levels of debt that we've never seen before. So simply, the fiscal outlook is unsustainable. So you could compare it to France, you could compare it to Japan on the debt ratios, but I think that it is really a moment where you have to look at what needs to be done, particularly if we see Treasury yields continue to rise, because all of this looked very benign when we were at zero Treasury yields, but you really can see how this actually can change by the course of a decade. We're not talking 50 years.
Joyce Chang, thank you so much. A tour de force with JP Morgan as always as well. Lisa, I haven't done the work on the H15 series, which is like from Volcker to now, on a full faith and credit and pick a duration, but you wonder where the yield breaks, where we break higher and persistently higher. I've gotten old waiting for that moment.
This is the issue. So many people are talking about a Fed funds rate at 4%, even some Fed officials. We're talking about persistently high inflation over the next few years. And people are getting more and more conviction to go into long-term Treasury, sending yields lower exactly because of what Joyce Chang just said. If this nation is facing such massive debts, it cannot sustain Treasury yields at 4%, 5%, 6% because the carrying costs become onerous. And this really is underpinning some of that conviction, the only conviction that you're seeing right now in markets.
Well, it would be that they would clear the market and improve the fiscal stance. And that would come, I mean, Kayleigh, one of the great surprises of the last, I'll say, 18 months, witnessed California and New York State, frankly, is burgeoning tax revenues have surprised all.
Yeah, that's true. And of course, there'll be changes to tax policy coming if assuming that the bill passed in the Senate over the weekend does get passed in the House. But of course, it is a much more muted change in the tax policy than was originally envisioned by the Biden administration. Yet that 1% tax on share buybacks could have implications for this equity market.
Well, you're David Sowerby. Go after that. We'll get a lot of different opinions on that across all of Bloomberg here on the share buyback derby. Maybe Mr. Cook of Cupertino will weigh in on that as well.
Oh, right. You think so?
Yeah, just possibly he'll weigh in. We'll see. Mark Gurman reporting on Apple. They got a soiree in September. Lisa demands I buy 7 new things from Apple.
Are you trying to get a road trip to Cupertino?
Yeah, we need that. $88 on West Texas
Always
Intermediate. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden and his party finally got the win they've been waiting for. The Senate passed the Democrats' landmark tax, climate and healthcare bill. The House is expected to pass the measure on Friday. It's a slimmed-down version of the $10 trillion plan progressives had sought more than a year ago. Now the question is whether it can give Democrats a boost going into November's congressional elections. San Francisco Fed President Mary Daly suggested a 0.5 percentage point increase isn't locked in at the next policy meeting. Daly told CBS News the central bank is far from done in bringing down inflation. A strong jobs report on Friday bolstered support for another 75 basis point rate hike by the Fed. China signaled that military activity around Taiwan was continuing past those drills announced in the wake of House Speaker Nancy Pelosi's visit. The Chinese military says it conducted anti-submarine and naval strike exercises today. The recent maneuvers near Taiwan have been the most provocative in decades. The United Nations Atomic Safety Agency has warned there's a real risk of a nuclear plant disaster in Ukraine. Hours after that warning, Ukrainian officials said that Russian forces shelled the area around Europe's largest nuclear power plant. Ukraine says Russia's shells landed near spent nuclear fuel. Moscow blamed Ukraine for the incident. And Warren Buffett bought the dip in the second quarter. His Berkshire Hathaway jumped on the market slump and was a net buyer of equities, reporting $3.8 billion in purchases. That made only a slight dent in its cash pile. Berkshire had $105.4 billion at the end of June, hardly moving from the $106 billion at the end of the first quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We are far from done yet. That's the promise to the American people. We are far from done. We're committed to bringing inflation down, and we'll continue to work until that job is fully done.
Some chat this weekend. Mary Daly there making a splash with the San Francisco Fed. She's one of the truly great stories in American economics, and she's been very visible here as we shift from forward guidance to data dependency. Lisa, how do you think we're doing on that? Data dependency? I thought it was a very guidance-y like weekend.
That's what I was going to say. We shift from forward guidance to forward guidance that's just a little bit different and under the guise of data dependency. At what point are we really looking at data, and which data exactly?
Yeah, it's going to be interesting to see. We welcome all of you. John Farrell off for the day. I got notice at Naples Airport, NAP in Italy, Lisa, they've got selected delays, so maybe his one-day house will be a little longer. We'll have to see. We'll be following that carefully here from Capri to Naples and back to New York. Kaylee Lyons pulling the short straw and joining this morning. Right now, Lisa was really talking this up as being of great, great interest. Amrita Sen joins us. She's chief analyst in energy aspects. Lisa, why don't you bring in Amrita Sen here on the microeconomics of that gallon of gas descending?
Yeah, so it's been shocking, right? It's been 50 some odd days straight of gasoline prices going down, and the real trigger lower for oil prices was this U.S. report that showed the gasoline demand was even lower this summer than going back to the 2020 doldrums of the pandemic era. And so I read a number of notes, Amrita, over the weekend saying, this number doesn't make sense. Does it make sense to you?
No, and we don't think the number is accurately representing what gasoline demand is in the U.S. So just a couple of things, right? This is summer, right? We've talked about this before. It's just low liquidity. Producer hedging is going on as well. So you are going to get very kind of sharp movements in prices, and you always get sell-offs in August. So that's the backdrop against which we are operating. And to your point, then we get some of these gasoline prints, then that starts or just proves to people who believe that we are already in a recession that, we must be in a recession. But if you look at these numbers carefully, the DOE on a weekly basis is coming out saying that, 2 weeks or 3 weeks ago, the number was also very, very poor, made a bit of an improvement 2 weeks ago, and then last week was a big dip. But then a couple of things on that. If you look at vehicle miles traveled, the June data point, which is the final data point, actually shows that vehicle miles traveled is up versus 2019. If you look at ethanol, about 10% is blended into gasoline. And if you gross the ethanol number up from the weekly numbers, you actually see that gasoline demand is about 9 million barrels per day, not 8.6 like the EIA is saying. There's a whole host of factors I can talk you through, but two of those are the most compelling ones where we have proven data as to why these weekly numbers are not accurate.
Amrita, what's the implication here? We've seen gasoline prices in the U.S. fall for 54 consecutive days. It's unheard of in terms of the trajectory. We're seeing oil prices now solidly below $90 a barrel traded on the NYMEX. Where should oil prices be based on what you're seeing in the raw data?
So the reason gasoline prices have come off is much more on the supply side. We have had petrochemical weakness, particularly in Asia, because China continues to be in and out of lockdowns. That's allowed a lot of naphtha in particular to be available, to be blended into gasoline. So it's not a demand problem, it's a supply problem. But in terms of where should prices be, I think in the near term, we can continue to weaken. We've got seasonally refinery maintenance coming up. This is always a weak period for crude. I'm not expecting to see a sudden increase in prices, but come the winter, particularly after November, 1st of November, the SPR stops. 1st of December, the Russian or European embargo on Russian crude starts as well. You've got the China Party Congress, which should allow, we believe at least, some easing in COVID restrictions. The market is going to tighten up very, very quickly. So we still maintain our forecast of over $120 by year end.
Wow. Amrita, I want to talk about demand. We spend all our time on supply side looking at first and second derivatives and gaming out something tangible we can put our hands on, or at least believe we can. We can't do that with demand. Does, for example, Saudi Arabia actually look at the dynamics, the second derivatives of oil and gas demand?
Yes, absolutely. And I think demand, which is precisely to your point, because it's so much harder. They do spend a lot of time, OPEC as a whole, particularly Saudi Arabia. And that's one of the big reasons why the increase in the group's production was just a nominal 100,000 barrels per day. The uncertainty is just too much for them to come and add a big amount of oil. Imagine if we are really going into a recession, again, not that we believe so, then they would have to take that oil back.
Well, Amrita, what is a big amount of oil that OPEC Plus could realistically produce? I mean, how much spare capacity actually is there?
Well, this is the other thing that they actually acknowledge, right? That the group, really outside the GCC, there isn't a lot of spare capacity. And I also really want to highlight the difference between spare capacity and surge capacity. A lot of our conversations with member countries will say, yeah, sure, we can increase by 300,000-400,000 barrels per day for 4 to 6 weeks. After that, we would actually have to take our fields down for maintenance. That is not spare capacity. Spare capacity is something that can be brought on in 30 days and sustained, right? That's something you do on a very short-term basis, but actually doesn't allow you to meet, let's say Libya goes offline, but if you can only bring that oil on for 4 weeks, then that doesn't solve the problem. And I think that's one of the big reasons why Prince Abdulaziz in particular has been very cautious about adding barrels back, because if you can't sustain it, then you lose control of the upside.
Amrita, thank you so much. Greatly appreciate it this morning. Greatly appreciate it. Amrita Sen with Energy Aspects today. Kaylee, I look at this game over oil, and it's just so profound how it folds into the inflation call on Wednesday.
Yeah, the headline at least. And you're also seeing it with food prices. You had food prices coming down according to the UN index. The biggest drop in July we've seen in years. We're now back to levels seen in January. So at the gas pump, at the grocery store, in theory, those things are easing. Then it becomes about core and that stickier inflation. And we expect that core metric is going to keep coming in hot. That's what the Federal Reserve is going to have to take a look at.
We're going to stop right now on Bloomberg Surveillance and do something that we love to do, which is drive forward the intellectual component of silence. Ted Love is at Global Blood Therapeutics. He's out of the acclaimed Harvard program in molecular biology, I believe through Yale Medicine. And he and GBT this morning were taken out by Pfizer. Lisa, this is one of the companies working as hard as they can on something new and modern. Only 110 years old is our understanding of sickle cell anemia, now sort of generalized, it's sickle cell disease. It's an extraordinary take on 400, 500 employees. But Lisa, this is a huge deal for molecular biology.
And it's $68.50 per share, $4.5 billion transaction. And it is a big deal when it comes to microbiology. It's also a big deal because it's one of a slew of transactions, particularly in the healthcare industry, that we have seen and are continuing to see. CVS also potentially bidding for Signify Health, expanding into home healthcare. Just so much going on at a time when the deals market was pretty much shut pre that June silence that you were talking about earlier.
Stock pops off a distressful bottom up in the 60 level as well. Futures up 21, Dow futures up 139, the VIX solid under 22. This is Bloomberg. Stay with us.
We're expecting an eventual slowdown. But it's not here yet.
We're not seeing the economy going over a cliff, and this is exactly the time that the Fed needs to be moving quickly.
We can see areas of the economy where they're very successful and areas where they need to continue.
They have to keep on raising rates. I just think we have to be careful about the level of rates that we get to.
There is this path to a soft landing. I don't see why people think it's such an elusive thing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. It is Merger Monday. Ferro missing all the excitement. Kaylee Lines in for John Ferro today. At least we believe he's stuck in an airport somewhere in Italy. Lisa, I'm sorry. Rip up the script. Forget about inflation. It's Merger Monday.
It's fascinating to see all of these deals being unleashed. Whirlpool paying $3 billion in cash for Emerson's waste disposal arm. That's the latest. We've also heard from Pfizer. We're also hearing about a CVS deal. So many deals after the quiet of the previous months. We had seen capital markets freeze up. They are opening up in force with the rebound that we've seen in stocks and the rebound that we've seen in bonds.
Small transactions, and I really got to say, I look at it and the media's, it's a waste disposal business. Baloney, come on, Lisa. This is what's in your sink. They're selling Incinerator. Emerson's getting rid of this dog. I've got the Quiet series at home. It eats up the olive pits. But the bottom line is, this is, again, bolt-on opportunity transactions. And here's the message, Lisa. Corporations are adjusting, whether it's Pfizer or it's Whirlpool.
Wait, hold on a second. You live in New York City and you have a garbage disposal? I mean, honestly, this is a whole other situation. I mean, honestly, that is its own experience, because normally whenever I go to Airbnbs and they have a garbage disposal, I get very excited. Look, this is interesting. It is coming at a time where you do have a real ambivalence, especially by CEOs, of what's to come with the inflation, with the macro, considering the fact that they have all of that uncertainty and they're still using their cash for these acquisitions is a pretty powerful statement.
I should finish that thought. Don't let the 108th mayor of New York know that I've got the Quiet series Incinerator that I put in and installed myself. It leaks. Let's move on, Kaylee, to where we are right now on inflation. And part of the animal spirit of this Merger Monday is nominal GDP where it is, the spirit there, and good corporate earnings.
Well, part of the animal spirits in this market, in this equity market, Tom, also have to do with the notion that the Fed is going to pivot eventually. But we saw a bit of a change forming in that idea on Friday when we got that blowout payrolls report. We're now pricing in about 80% odds of another 75 basis point hike come September, which, yes, is a long way away. But the data we get on CPI on Wednesday could be extremely formative in that decision.
Avalara? Oh, yeah. Kaylee, come on. You're the fun of wisdom here. You were on this deal last night at 2 p.m. Seattle, Washington, 4,400 people. Avalara, they provide sales tax management here on Merger Monday.
And Vista Equity buying that company for $93.50 a share in cash. So that makes it, what, Lisa, 4 deals that we have announced?
That we either have announced or rumors of this morning, which is, Pretty typical for a merger Monday, but this is an anomaly in inflation 2022.
Well, let's get back on the rails right now. We got futures up 20, Dow futures up 137, and the VIX with that move, 10 big figures from 32 into 22, 21.56 on the VIX right now. So a nice move here. The percentage move on the NASDAQ 100 gets my attention, up almost 0.7%. In the yield space, the headline for me is continued inversion. The pros writing about this over the weekend, a negative 43 basis points. Oil, thank you, Amrita Sen, reaffirming $120 Brent crude right now. Brent south of that by a modest $20. Lisa, what do you have?
Yeah, and I got to say, this morning has actually been fascinating because Joyce Chang coming out and talking about the overhang of debt and how that's going to send yields potentially lower over the long term because it will crimp growth and it will necessitate a lower yield to be functional as a nation. Wednesday, we get a sense of how high the inflation is right now and what the Fed may have to do to curtail it. We get U.S. July CPI. We will be looking at the headline number. The expectation based on the survey is 8.7, down from 9.1%. The trajectory is good. How much it's coming down, it's still a pretty heady number at 8.7. Core inflation, though, how much does that continue to rise? This is stripping out energy, stripping out food. How much do you get a stickier feel as you've got rents increasing and you've got medical costs increasing and you do have the roving inflation moving to those areas? Thursday, we get a sense of what's going on with the prices that factories and manufacturers are paying. We get U.S. July PPI, which has climbed to record heights and climbed far beyond where we are seeing consumer prices. How much does this bleed into the Mike Wilson view of things, that you see margins compressed and continually compressed, and that people are behind, Tom, in how much they're expecting? And this, to me, I think is one big theme.
Well, that's really important, folks, to see a bear come out like Mike Wilson and really intelligently reframe caution here. Savita Subramanian at Bank of America the same way. Lisa, moments ago, John Stolfus, who's absolutely nailed this rally, says further legs to go in a great bull market. Stolfus, of course, over at OPCO. Lisa?
Yeah, and both sides are digging in their heels, the bulls and the bears, and saying, everybody, you guys are missing the boat. And this is really a faith-based market. Friday, how much is the faith getting people through that they will be able to have jobs and that they will be able to fill their tanks? We get the University of Michigan August Consumer Sentiment Survey. Does that confirm the feeling that we're seeing, certainly in other anecdotal data, that people are feeling a little better?
Speaking of missing the boat, a good time to segue over to Peter Scheer. He's head of macro strategy at Academy Securities. Academy is in Annapolis and, of course, is a Wall Street shop with a huge military bent. Peter, I would be remiss if I didn't speak to you of your board's esteemed public service and their thoughts on what we're seeing on the Pacific Rim and Taiwan. Has that affected your call across the broad market?
Yeah, it's something we're very focused on. We have 17 retired generals and admirals who serve as our geopolitical intelligence group, and about 50% of the company are veterans. So first, it's very near and dear to our hearts, but I think we are looking at the escalation of what China is doing, and it doesn't necessarily turn into something military, but it plays on this theme that we've been seeing China separate from the rest of the world, become much more inward looking, and China is going to continue to develop relationships with autocratic nations at the expense of dealing with the West.
Peter, how much do you buy into this rally that we've seen, the 13% gain in the S&P since that mid-June low? How much do you view this as wishful thinking at a time of so much geopolitical and inflationary uncertainty?
I would say I think it's very wishful thinking. Having said that, with VIX down at 22, I like the idea of just buying calls and puts coming into the end of the summer. There is so little liquidity. Either side could get traction. It feels right now, again, the bulls are getting traction, especially after we, survived Friday. But to me, the inventory overhang, that remains a big concern. And I'm just a little bit suspicious about how good the job data was on Friday.
Suspicious in that it's not going to turn out to be that strong once we get the revisions, Peter?
Yeah, there's already, right now, over the last 4 months, you've had this big disconnect between the establishment survey, which is the headline number, and then the household survey, which goes into the unemployment rate. There are about 1.8 million jobs different over the last 4 months, which is a pretty big thing. So if the household started to confirm what we're seeing in the establishment, that would mean that the unemployment rate is probably much, much lower, which puts pressure on the Fed, or we're going to get some revisions. And I suspect it's going to be more revisions to the establishment, and it'll pull us a little bit more in line with other anecdotal evidence on jobs.
Does that mean you're more in line with the Fed pivot narrative?
Yes, I think the Fed is going to have to pivot. I think the Fed's already gone too far. I think you're seeing inflation roll over. I think you see supply chains fix themselves, but it's the fact that the consumer looks like they're trying to buy things on discount, that you're seeing margin pressure. I think all those are actually going to be relatively, I don't know that we get to the point of being deflationary,
Right.
but I think by the end of this year, we're not talking about inflation anymore.
Peter, it's Inside Baseball Monday. That's what you do when the Padres are swept by the Dodgers, so we're going there. Peter, I think I just heard you say you want to do a collared transaction because we may go long or we may go short. You and I remember long ago when you do like a 6-option trade and Peter Scheer would do an iron condor or something like that. Can you be creative in options now, or do you eat it all up in premium?
You eat some of it in premium, but again, as you mentioned, VIX is all the way back to 22. So VIX is pretty low given the day-to-day volatility we're seeing. So I think you can trade your way out of it.
Pete, how much is a Fed pivot going to be positive for equities versus negative?
I think it's going to turn out to be more negative at first. I think the realization that the market hasn't hit is the Fed is going to be pivoting because they've pushed too far. So I'm definitely not in the soft landing camp. I think we pushed too far. I think we're seeing the consumer rollover. I think you're seeing inventories build. So when people realize that we're going to have to pivot, the first reaction, yes, maybe we rally, and I think that's the stage we've been in. But then the reality is going to hit like, whoa, we have to be very careful. What are future earnings going to look like? And it's very encouraging to see this kind of merger Monday because you're seeing companies kind of accept new valuations. But I think we're a long way from being done, especially on the high flyers where they still want to get paid X, the buyers are at Y, and we've got to sort themselves out. And I think, unfortunately, it's going to be closer to Y, the lower prices that come to fruition.
Peter Scheer, thank you so much. Greatly appreciate it with Academy Securities there, particularly the update on their thoughts on what's going on in the Pacific Rim. Lisa, no surprise here. It's a president that maybe wants to drive the victory lap forward. This is a president, of course, COVID-free, I believe 2 negative tests, Lisa.
Yeah.
I remember when I had that in January, I think it was, and, you know, you get 1 and you're like, okay, now what? And then you get 2 and you feel a lot better. In Delaware, we may hear from the president in the 8 o'clock hour.
Yeah, he's leaving Delaware at around 8:30 a.m. He is in his beach house in Rehoboth, and he's going to be flying to Kentucky to visit some of the flood victims there. How much does he really talk up the victory of a bill? It hasn't yet been passed. He has to talk about that. How much does he also talk about gas prices? Because that perhaps is going to affect things more than anything else when it comes to the midterm elections, considering how quickly they've come down. I mean, it's really dramatic, Tom.
It really is, but where does the level where the nation gets comfort, both Republicans and Democrats? Kaylee, you know, Lisa and I, well, I mean, Lisa had the stint in Fargo where she drove 50 miles for a quart of milk. But other than that, Lisa and I don't even get in a car anymore. Kaylee, you're living this dream. I mean, we got to get back under $3 before we get a sigh of relief, right?
Well, things are looking better. $3 might be a little ambitious, Tom. I will say, I just bought a car last week.
Did you?
So I will be filling up my tank more. Yeah, I moved to the transformation from Manhattan to Brooklyn.
Yeah, but the thing is, Lisa, she got the BMW with the slope seat where, you know, I can't sit up in it. I mean, you know, it's like a sporty thing.
Most of cars Tom Keene fits into, probably very
there's
short.
like 3, the Hummer H3 and the Hummer H2. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Senate has passed a landmark tax, climate and healthcare bill, giving President Biden a victory on his domestic agenda. Still, the measure is a shadow of the $10 trillion plan that progressives had hoped for more than a year ago. The bill now goes to the Senate, or to the House, where the Democratic majority is expected to pass it on Friday. A surprise change at the top of private equity giant Carlyle Group. CEO Koo-sung Lee has stepped down. Lee's 5-year employment contract was due to expire at the end of the year. Bloomberg's learned that Lee and Carlyle's board have clashed over the contract in recent discussions. The firm's co-founder, Bill Conway, will step in as interim CEO. Hong Kong has reduced the amount of time travelers entering the city must spend in hotel quarantine from 7 days to 3. That's a greater than expected easing of its strict travel curbs. But Hong Kong is still an outlier in a world that's mostly reverted to pre-pandemic movement. And Pfizer's agreed to buy Global Blood Therapeutics in a deal valued at about $5.4 billion. That will give Pfizer one of the few approved treatments for sickle cell disease. The disorder affects 20 million people, including many who are black. And SoftBank has reported a record $23.4 billion quarterly loss. The sell-off in global tech stocks continued to hammer its Vision Fund portfolio of investments, such as Uber. Meanwhile, SoftBank has begun talks to sell its asset manager Fortress Investment Group. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Beijing government is currently trying to manufacture a crisis over a practice that has been ongoing for decades. It's really up to Beijing to decide if their rejuvenation, if China's rejuvenation will evolve with international respect or with international condemnation.
Important words from a representative of Taiwan, that on Face the Nation on CBS this weekend. And of course, we're continuing to monitor that story. I believe Enda Curran scheduled to be with us from Hong Kong here in a bit. Lisa, an important adjustment. Thank you to Javier Blas leading our oil coverage for this, where Mr. Curry adjusts at Goldman Sachs.
Yeah, and then we've seen that pretty steadily, although still seeing upside down the line. But what we are seeing is people reducing their short-term targets because of how much we've seen the declines really gain steam despite the tight supplies that we keep talking about, Tom.
Yeah, we see that right now. Let me give you those numbers here. Goldman Sachs from a 135 down to 118, but for next year they sustain at 125, and Amrita Sen with Energy Aspects really giving us the same message here moments ago. Always with the same message as Jack Fitzpatrick of Bloomberg Government. Jack, I spent a good part of the weekend looking into some of the mathematics of the great surprise, and that is the Latino, the Hispanic vote, which has shifted Democrat to Republican. I happen to pick an area I know the geography well of. Thank you to Boulder and CU for that. And that is Pueblo, Colorado, east of Colorado Springs. It is thunderous how the Republicans have taken the Latino vote in selected geographies. How does that change Washington in November?
It definitely plays into the expectations of, one, in November, it helps Republicans in the midterms. It also, I think, in the big picture, aside from picking some interesting races here and there, makes Republicans feel a lot better about the presidential, their chances in the next presidential race. Florida especially, you know, the Hispanic voters of America are not a monolith. If you're talking about a major swing state that has not been quite as swingy lately, looking at Florida, the Cuban Americans there who are particularly conservative, the people who have been really open to Republicans' arguments about Democrats leaning socialist, as Republicans would call it, it probably is an even bigger factor looking to 2024 than in the midterms, but we have seen it play up in the midterms in primaries as well.
Our Greg Giroux, who's scaringly expert on this, has just been phenomenal. Wasserman, of course, owns the high ground. And I thought Mike Allen at Axios this weekend really had an extended note on this. Is it enough to decide the Senate in November, Jack?
It's very difficult to say.
I agree.
Because there's so many factors playing into the Senate. You know, I think one overriding factor that we still don't know exactly how it's going to play out in Senate races is actually the response to the Supreme Court's Dobbs decision, and we don't know how much that's going to maybe outweigh other concerns. I'm not sure exactly how much the shifting expectations of how Hispanic voters will play specifically in Senate races. But in the long term, it's something Republicans have to be happy about. It's just these midterms are tough to pin down, seeing the struggles of the president and his popularity, but meanwhile growing enthusiasm among Democrats, especially after the Dobbs ruling. We still really don't know what the main story is going to be of the midterms. Obviously, Republicans feel better than Democrats, but there are kind of conflicting narratives right now.
I'll give you another narrative that's conflicting, and it could be a potential driver, and that's gas prices. We've been talking about it all year, but particularly today, as we get a 55th straight, perhaps, if we get the continuing of the streak, decline in gasoline prices in the United States. Is that enough? Tom raised this question earlier. Is that enough to get gasoline prices down to, on average, $4 a gallon, for that to make people feel better enough to give Biden a reprieve on inflation?
I would be skeptical that that's good enough so that people would be overall feeling really good about the economy. It's better for gas prices to be going down than up, obviously, and to have an extended streak is a nice thing, but they're not particularly low. And still, if you just generally look at polling on how people feel about the state of the economy and how Biden has handled the economy, it's fairly negative. There's reason to believe it gets better potentially from here until November, but that's not long enough to anticipate that it absolutely is going to turn around. Right now, overall, the economy, and voters can lump all of these together, and the economy is a net negative for Democrats right now.
Okay, so if it's not long enough to essentially turn around the economic trajectory and the way Americans are feeling about it, is it long enough for any other kind of legislative victory for the Biden administration and the Democrats, or is what we saw passed over the weekend really going to be the extent of it?
This one would be a big one that the Biden administration would campaign on, this bill that just passed the Senate. I don't know if that, again, has an economic effect in the near term that turns things around for them from now until the midterms. It's not an easy path for Democrats from here to the midterms, but this bill, as well as the CHIPS bill that the president's supposed to sign into law tomorrow, the fact that they got those in the span of a week and a half is a big deal for Democrats. More of a long-term issue than something that flips the switch for them immediately ahead of the midterms. But those really are going to be two of their main accomplishments that they'll campaign on, as well as the infrastructure bill that happened earlier.
Jack, thank you so much for the brief, particularly there on Latino voting as we move out to November, and out to 2024. Lisa, I've been waiting for this. It is published moments ago by NBER. You know them as the recession gaugers, but also a terrific research opportunity for all interested in economics. Moments ago, Lisa, David Blanchflower of Dartmouth with Alex Bryson and Jackson Sperling published an updated working paper on not unemployment in America, Lisa, but underemployment. Blanchflower is heated that we get our analysis wrong, and particularly in the linkage of wage inflation.
Does he basically talk about a slack that we're perhaps not tracking in the market, and that's why the labor market isn't as robust as people are saying? Because that's been his argument for a long time, and why he thinks the Fed is making a mistake by going too far, too fast, by hiking it all.
It is a partition versus a homogenous study, and his partition is part-time people that want to be full-time people. Blanchflower would say that's definitive in a lot more of America than anybody wants to look at when they bundle in all of the studies. Of course, that's part of the bang-up jobs report we saw a few days ago. Futures up 18, they advance. This is Bloomberg. Good morning. Bloomberg surveillance on a Monday before Inflation Wednesday. Huge data point Wednesday. Some would say bigger than the jobs report that we saw on Friday, and look what that did. John Ferro off at least today. We're unsure where he's going to be tomorrow. I believe he's stuck at the Naples airport off of Capri, but delays and all that. Kaylee Line's in today, at least right now. Futures up 16, up 18 moments ago. The VIX under 22 gets my attention. And I do want to mention something we've been remiss on in the last 90 minutes, and that is dollar dynamics, with a huge resiliency to the dollar off the jobs report. A churning today with a 106 level on DXY, euro 101.93, and yen 134.78. Just to look at the major pairs, I should note Turkish lira holding at 18 lira per dollar, 17.96 on Turkish lira. I think that was enough of an aggregated data check.
Hold on a second. Can I actually offer up a little bit of a fact check here? John is going to be stuck in Capri all week. He is going to be permanently stuck there. And we have the privilege of having Kaylee with us for the whole week, unless she runs away because she's thinking, oh my goodness, if John comes back from Capri, which he will not. So, Tom, just want to give that little clarification.
I thought he was on Halls for one day.
That's an American holiday.
He just was on Halls like 2 weeks ago.
He's European. All right, well, let's move on. Let's take a look at some of the stocks. We've been talking all morning how it is Merger Monday, which is fascinating because it hasn't been Merger Monday for quite a while. So let's look at some of the mergers. CVS Health talking about buying Signify as they expand into home health care. And you can see Signify shares popping more than 16% ahead of the open. CVS shares a little change, down about 0.25%. Nothing to write home about. And really, the Emerson story is that Whirlpool is going to buy this company. Those shares up a little more than 1%. That's not the story. The story is that Tom Keene has a garbage disposal unit in his apartment in New York City. So I'm going to bring all of my cucumber peels for your apartment, and we can discuss.
Got a waiver on that.
I will try. Also in the news very much today is that bill that was passed by the Senate, now heading to the House. We could see that Tesla and Rivian both benefiting from some of the potential electric vehicle credits. Tesla shares up 1.6%. Rivian, which has been completely hammered. I mean, take a look at those shares. They've been absolutely decimated, up 1.4%. A pretty nominal move considering how much they've been tanked. And Global Blood Therapeutics, Tom, you were talking about this earlier. It really is a fascinating deal. Pfizer planning to buy this company that has some groundbreaking sickle cell anemia treatments at a time when a lot of people are looking to the new advancements in the pharmaceutical industry post-COVID.
Interesting to see that. Right now on fixed income, we're going to drive to Mark Cabana, head of U.S. rate strategy at Bank of America Global Research. This is a timely update on where we are and where we're heading. Mark, let me go with a general question here. In your research this weekend, in your writing, what is the distinction of the Bank of America view?
So the Bank of America view has been very cautious on the outlook, expecting to see a slowdown in the labor market and ultimately see that weigh on consumer spending and then business spending. However, the data that we got on Friday was incredibly strong. Much stronger than we in consensus were anticipating, really much stronger than anybody on the street seems to have been anticipating. And it does question how quickly we're going to ultimately see that slowdown if the labor market is indeed this resilient.
And this links into Savita Subramanian's work in the equity market is, well, Mark, there's a wide gap between those looking for 4% up Fed outcome and let's call it a 2.5% to 3% Fed outcome. How do our listeners and viewers actually play this massive diversion in outlook?
Yeah, well, just like the Fed, unfortunately, I think that investors have to be very data dependent right now. And what the data is showing us in the U.S. is that we're not seeing enough of a slowdown yet for the Fed yet to call the quits. So the Fed, as they've signaled, they're going to keep raising interest rates. We now think 50 in September, another 50 in November, and then 25 in December before they're finished. That's 125 basis points of additional hikes this year. It seems like the market is anticipating something similar. But the question is, how long can the Fed sustain these elevated rates? The market is certainly skeptical, pricing in cuts in the second half of next year, and we think that's right. We also question how sustainable these elevated levels of short-term interest rates will be, and that's one of the reasons why you're seeing the curve so inverted. It seems like the curve certainly agrees with this notion that, yeah, the Fed may be able to raise rates today, but that's going to mean a slowdown tomorrow, and it's not going to be sustained. The Fed's going to have to be cutting at some point in order to prevent the economy from slowing too much.
Mark, I'm glad you mentioned inversion. I have the yield curve in front of me right now, and I'm looking at more than 42 basis points. That is how much higher the 2-year yield is than the 10-year yield. Typically, this portends recession, usually within as soon as 9 months. Where do you see this basically as a predictor of some sort of downturn? How long do we have? Does the depth of the yield curve inversion signify some sort of significant downturn or the magnitude therein?
So it certainly signals that the Fed is not going to be able to sustain the level of short-term interest rates that the market is currently implying. That we think is clear and unambiguous. As you know, inversions typically precede recessions, but not always. There's a great phrase in the bond market, something like the yield curve has predicted 10 out of the last 5 recessions, or something to that effect. So it's not always the case, but it does tend to be a pretty good indicator that things will slow down. And what it is clearly indicating is that the Fed will not be able to sustain the very elevated level of short-term interest rates for all that long. And we certainly agree with that. Recession or not, we can debate. The B of A view is that we do think we're headed into one. But regardless, the yield curve is certainly indicating that the Fed won't be able to sustain these levels for all that long.
I'm kind of confused. I got to say, I'm trying to put together this idea that you think that the numbers were too high for the jobs report and that they've got to come down. And you think that the Fed's going to pivot next year. What's going to make them pivot if we're seeing CPI potentially even at 8.7%, which is the consensus, which is still so far above that 2% level?
Yeah, so we think that, look, the labor market right now is very strong. Inflation is very high. But importantly, what's going to get the Fed to pivot is that both of those are going to come down. We do believe that the Fed will be successful at generating a slowdown in the labor market. We do believe that the tightening of financial conditions that we have already seen is likely causing certainly employers to rethink CapEx, employers to rethink hiring plans. And we do think that that's going to manifest itself over time. It's also going to weigh on the consumer, and that's going to help bring down both the elevated inflation that we see today, and it's going to allow for the labor market to ease to some extent. But look, those are two core tenets of our views. And if we're wrong, then the overall level of rates has to be higher in the economy. But we think we will indeed see that slowdown. We don't think it's going to be all that far away. That's what's ultimately going to allow then the Fed to pause and ultimately shift to rate cuts later next year.
Okay, so until we get to that point where we have some clarity as to whether or not the Fed has accomplished what it set out to do, Mark, how much volatility can we expect to continue seeing in the bond market? Because it has been dramatic, to say the least.
I know. It's been exhausting. It's been an exhausting 2022, I think, for everybody really in financial markets and especially in the bond market. But we do expect that as the Fed sees some signs that the economy is slowing, we think that you're going to see interest rate volatility start to moderate, at least peak, and then ultimately decline. The fixed income market really moved in that direction a bit after the July FOMC meeting, where Powell indicated that they're probably going to move slower once they're above their perceived level of nominal neutral. And we still think that the Fed is biased to do that. Having a Fed that ultimately slows down, even if it means 50 basis point rate increases in September or maybe November, that will help decrease overall volatility until there is more clarity on the overall economic outlook. Look, it's not unusual to see elevated economic volatility, to see really mixed messages from the data when you're at this part of a cycle where you're near the end of a broad expansion. And we do think that as, again, we see clearer signs that the deceleration is upon us, the Fed is going to be able to signal that they will begin to slow things down. And ultimately, that will lower implied volatility and realized volatility in the fixed income market.
Okay, so if overall movement will be subdued, what trajectory is it going to be from here, Mark? If you're talking about getting to 3.5 to 3.75% by year end, where does that put the 10-year?
Yeah, so for our 10-year forecasts, look, we think that they're going to end the year right around here. We've been of the view that 10s will end the year at 2.75%, and that the curve is going to probably run the risk of becoming even more inverted, at least in the near term. Again, as the Fed signals that they really want to move rates higher in order to slow the economy, and then they'll ultimately get the outcome that they want, and that's going to mean that they're going to be cutting next year and probably into 2024. So 10s, we think, are going to be somewhat stuck around these levels, and we've been encouraging clients to lean long duration because there will be a slowdown coming. The Fed will be successful, and that's just going to limit how high 10s can ultimately move.
Well, let me ask you a historic question around that. I'm looking at acceleration of inversion, Mark, that harkens back to June of 1980. If we get the speed of inversion you're talking about, is Powell like Volcker?
So, look, Powell wants to be like Volcker in that he wants to ensure price stability. He doesn't necessarily want to engineer as sharp of an economic slowdown as Volcker needed in order to get that, but he's going to do what it takes in order to see inflation moderate. Now, the good thing is that the market and surveys of consumers generally suggest that the Fed is still credible. I mean, look at the tips market. The tips market is not pricing in any type of concern about runaway inflation today.
Right.
We'll get another update in the UMich survey on Friday. The most recent reading on that suggested that, five-year forward inflation was also expected to be somewhat limited. And because of that, because the Fed is seen as so credible, that really does help them likely not have to go to the same extremes that Volcker did. But I think Powell would very much appreciate the comparison of him to Volcker if it does mean that he's got those inflation-fighting credentials.
Mark, thanks for the update. Mark Urbano with us with Bank of America Global Research there with a real caution, I would say, across equities and bonds as well. Futures up 18, Dow futures up 116. The VIX churning here with a 21 level. That gets my attention as well. And yes, in the yield space, wow, 3.23%, the 2-year yield. On Washington, Libby Cantrell in the 8:30 moment. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden and his party finally got the win they've been waiting for. The Senate passed the Democrats' landmark tax, climate, and healthcare bill. The House is expected to pass the measure on Friday. It's a slimmed-down version of the $10 trillion plan progressives had sought more than a year ago. Now the question is whether it can give Democrats a boost going into November's congressional elections. China signaled that military activity around Taiwan was continuing past those drills announced in the wake of House Speaker Nancy Pelosi's visit. The Chinese military says it conducted anti-submarine and naval strike exercises today. The recent maneuvers near Taiwan have been the most provocative in decades. And Egypt has mediated an end to 3 days of violence between Israel and Islamic Jihad. The fighting left 44 people dead in the Gaza Strip, and it sent thousands of Israelis into shelters to avoid almost 1,000 rockets fired into Israel. The confrontation began last week when Israel killed an Islamic Jihad leader. And Whirlpool will buy Emerson Electric's waste disposal business in a $3 billion transaction. The business known as Incinerator makes garbage disposal products, instant hot water taps, and water filters. Whirlpool said last month that demand for appliances has dipped and would likely remain suppressed through this year. Warren Buffett bought the dip in the second quarter. His Berkshire Hathaway jumped on the market slump and was a net buyer of equities, reporting $3.8 billion in purchases. That made only a slight dent in its cash pile. Berkshire had $105.4 billion at the end of June, hardly moving from the $106 billion at the end of the first quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The differences between Taiwan and the mainland need to be resolved peacefully. And what we've seen China do over the last few years is move away from a peaceful resolution of differences to doing so coercively and potentially forcefully.
The Secretary of State, Antony Blinken, they're on a tour of China. He's been very, very forceful. It's been interesting to see, including a first meeting with Mr. Marcos Jr. In the Philippines. It's certainly an historic moment to see Marcos take the leadership of the Philippines after many, many years. Right now on China, and Lisa read more on China this weekend. I was more focused on the tots and you know how they did with Southampton
and your garbage disposal.
Yeah, what was amazing, Lisa, was Ferro was at the game, and you know he texted me from the Marmite box on his way to Capri, and you know he got tickets somehow.
The Marmite box.
He's at the Marmite box, so it was good to see that 4-1 as the tots take it out. So Lisa, why don't you lead off with Mr. Curran in Hong Kong here on the disruption in China?
Well, so we've been talking a lot about what's going on with the Taiwan airstrikes, or not the airstrikes, the sorties being operated to send a warning shot as retaliation for Nancy Pelosi's visit to Taiwan. Enda Curran, who is our Asian correspondent for all things economics, the more interesting aspect over the weekend to me was the trade balance data, which suggested a record trade surplus for China, even though imports from the U.S. are falling. What gives? Why does this sort of represent strength at a time when all other signs point to weakness in China?
So you're right, Lisa. It was a surprise number, a bumper figure for Chinese exports. Like I mentioned, some of it is being put down to that post-lockdown rebound still underway. So we know that, supply chains have been improving, factories coming back online, etc. So some of it's been put down to that. There's also talk of solid demand, like in Southeast Asia, for example, and other parts of the region. But nonetheless, it doesn't quite gel with the indicators we're getting in the forward indicators, for example, in the PMIs. Some of the analysts, I think it was Pantheon today, making the point that actually some of this could be down to China's energy exports, inflating the overall number. But regardless of how you slice and dice it, a lot of people are saying nonetheless that the merchandise goods story out of China will cool off into the second half of this year and probably cool off quite sharply, reflecting inventories globally, reflecting interest rates and inflation globally. So, a big surprise in the China export story, some devil in the detail, but I don't think anybody really expects it to remain as strong as we head into the back end of this year.
Yeah, the Pantheon data highlighting that that China is exporting a lot of oil goods to Europe and to Japan and other Asian nations, and they are a net importer of Russian oil, allegedly, and they could be exporting their refined goods and taking the arbitrage. That aside, there is a question about whether the CCP will move away from zero COVID after November. This is something Joyce Chang was talking about, as well as Amrita Sen, in terms of increasing demand for oil and increasing some of the uncertainty later in the year. How much is Hong Kong a template for that versus an outlier as they move to curb some of the quarantine requirements?
Well, it is a big question, Lisa. So we did have movement on the quarantine restrictions in Hong Kong today. It's been cut back now to 3 days in a hotel and then 4 days of self-monitoring with some conditions attached effectively. Now, so on a headline basis, you'd say that's clearly a positive for Hong Kong. It will help mobility. It will help the residents on the ground here. But nonetheless, though, it's still, quarantine for 3 days. The rest of the world, much of the rest of the world has moved on. Much of the rest of the world's financial centers have moved on. There is a debate over how come this is happening? How come China is allowing Hong Kong to go this way? Are they using Hong Kong as something of a petri dish? Well, we do know that from the top down, when President Xi came here a few weeks ago, he did make the point that Hong Kong has some wriggle room on this under the so-called one country, two systems. So perhaps the authorities here are using that wiggle room. But there is a view that China is also watching closely what happens here as a model for their own eventual exit.
And a completely unfair question. Does China have a Dr. Fauci? I mean, who's, Butch Cassidy and the Sundance Kid? Who are those guys? Who's actually making COVID policy in China?
Well, they do have their own prominent scientists. They have the head of their own disease agency, just like the US and others do, Tom. And some of these, both present and former officials, are quite high profile on China's social media. But of course, the big debate with China is, okay, you've got the science and the health aspect to it, but how much of it ultimately is being driven by the politics? And the politics being that China has reaped a big dividend, a public health dividend and an economic dividend out of COVID zero until this year, at least. This year has been a big test of it. But at the same time, they're at a point now where if they do let it go, we'll say the way the Western world, so to speak, is gone, then obviously they will face a pretty big disruptive exit wave and, of course, the risk of fatalities that go with that. But above it all, we all know the story, which is the big Congress, the most important political event in a decade, Citigroup called it. That's due to go ahead at some point later this year, maybe November. Obviously, the authorities don't want a public health disaster ahead of that. So I think that's to answer your point. I mean, the scientists are there. They do have their say, but the ultimate driver of this at the moment, I do think, seems to be more politics than anything else.
Well, and we know that the pandemic isn't the only political problem for Xi Jinping. There's also turmoil in the property sector. And how much more stimulus and supportive measures can we realistically expect before that Congress, considering that is the situation that looks like it's just rapidly deteriorating every single day?
It does seem that it will be somewhat tempered. I mean, the statements we've had from the Politburo and other official commentaries making the point that the government is willing to tolerate some economic pain as long as they can keep things somewhat stable, So, put a floor under the housing sector, which, as you say, isn't evidently clear that they have done that yet, but they're trying to put a floor under that sector, put a floor under consumer sentiment, keep things ticking over. Economists talking about maybe 4% growth rate. Obviously, that's much slower than it has been and will be well below the government's target, which is unusual. But nonetheless, though, it stops the economy falling into a hole. But we're not getting signals or narrative that the old growth model that people talk about in China, whereby the government comes along and puts a lot of money into the economy, just spends left and right, maybe on infrastructure in particular, in the way it has done in the past. That particular cycle doesn't feel like it is coming this time. They're trying to manage, they're trying to navigate, and they're trying not to fall further into that debt trap that is a problem for China's economy.
And thank you so much for the brief and your late evening. Enda Curran with us here from Hong Kong. Lisa, in all the reading of the weekend, and as you dive into a week, and particularly with inflation reports on Wednesday, there can be one sentence that sticks out. This is from Peter Bookvar over at Bleakley Advisory. And this is on the BBC, Lisa, and this is the head of JetBlue, Robin Hayes, saying, I now need to overhire. To me, that is a fascinating sentence about the labor economy to come and wage dynamics.
Basically, speaking to the Great Resignation, talking about attrition, talking about how in order to have the qualified people that they need and to be able to keep their planes operating so you don't get stuck on the tarmac heading to Atlanta instead of Puerto Rico, that you need to have an overfilled bench of potential people. And you're seeing this across the board. How much are companies going to avoid firing in the downturn in order to get ahead of this whole trend?
And as Mr. Hayes says, to overhire, absolutely fascinating. That quote just stopped me in my tracks. Thank you, Peter Bookvar, for that. Futures advance up 18 has become up 24. Well, I guess it's a bull market. This is Bloomberg. Good morning.
It's important to recognize that when you're in bear markets, they don't go straight down. They have ratchets.
This rally could continue for a little bit longer, but we wouldn't chase it.
The market seems to be more convinced that inflation is close to a peak.
Core inflation that really represents how tight the domestic economy is still rising.
I think inflation is going to slow organically.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Merger Monday ahead of CPI Wednesday and University of Michigan Friday. From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. John Ferro out all week, not just today. And Kayleigh Lyons, very much. We are grateful to have her in the studio all week, not just today. And Tom Keene, what I am struck by is the stubbornness of this rally despite the wall of worry.
Listen to you. It sounds like the gloom from Bramo, folks. You know what it is? Let's look at it now. The persistency of the rally is remarkable. Off of June 16th, SPX is now up 14% off the futures this morning. Since July 1, up 10%. And the first few days of August, even we had on 1.2%. I'm sorry, Lisa, futures up 23.
Yes, are you all out of triple leverage to all cash? Or do you see the wall of worry as having legitimacy beyond September, beyond October, beyond November, when we start to assess the Fed pivot, when we start to assess whether the labor market can retain the strength?
It's the ambiguity on the Jackson Hole, and the ambiguity is framed by the Fed parlor game, which is what, a terminal rate of 2.5, 2.75, 3%, and way out Anna Wong of Bloomberg Economics out at a 5-ish, 4.75%. I mean, the gamesmanship here, Lisa, into Q4, we've never seen.
Yeah, especially at a time when oil prices have been swinging so wildly. And I got to say, Kayleigh, that has been one of the most undertold stories of the past few weeks with this rally. The idea that oil went from well above $100 a barrel, no matter which way you slice it, Brent or WTI, to below $90 and heading even lower on the NYMEX. How much do we see that fueling this perception of rolling off in inflation?
Well, that on the headline, yeah, absolutely. And same with food prices, which have come down substantially as well. Then it becomes about core and those sticky price pressures that the Fed is going to have to contend with, because what started as just gas and groceries has broadened out in this economy. That is something that the Fed continually is saying, we're not done yet in trying to fight. We are going to continue to push to get inflation lower. It raises a question of if the market has it wrong, if the Fed just has some kind of communication problem. But the yield curve inverted by 43 basis points right now on 2s10s.
Tom, what did you make of Amrita Sen basically saying that by the end of this year, we're going to end up with still that $120 a barrel, and that you're going to get the roll-off of the SPR, you're going to get China back online because they're going to get rid of the zero COVID to some degree, or at least soften it, and suddenly the scene changes. Let's
take a moment here, Lisa, because I think this is really important, and it reaffirms who Jeff Curry with 120-ish call for 2023 as well at Goldman Sachs. The arch call of those that look for higher oil prices is on the demand side. It's not the romance of what Saudi Arabia doing or Russia, da-da-da. It's about demand, and particularly emerging market demand. COVID will end. China will do better in some way, and that will bring on oil demand. That's the core of their thesis.
Well, and we're looking right now to see how that plays out at this persistent moment of gains. And just going through some of the gains, and Tom, you were talking about it earlier, we are seeing it continue to mount heading into the open, with the NASDAQ up 0.7%, the S&P doing a little less good, but still up at nearly 0.6% on this merger Monday, which we really have to get into, just really deepening our understanding of Tom Keene's garbage disposal that he owns and Emerson's purchase by Whirlpool. We are seeing the 10-year continue to go down. And Tom, you've been talking about this, 2.79% at a time where the 2-year well above 3%, that curve inversion feeding some of that wall of worry.
Single most important data point before we get to Matt Brill, Lisa, is 43 basis points. Let me define that right now for those removed from global Wall Street. The difference in yield between the 2-year and the 10-year, which is 0.43 percentage points. As Lisa knows, you move the decimal point over. She did this years ago at Chicago Constitutional Law. Lisa, help me here. You move the decimal point over to hundredths, and it's 43 basis points is what Randy Krosner would say.
Yeah, what we're looking at right now is a little bit less than half a percentage point. That is.
Did the walls shake when you walked into Booth School years ago? Did the walls shake?
I'm not sure where to go with that, Tom. I don't really recall, but I will say we do have someone who can recall that yield curve and give us some insight into how low it can go and how negative, how inverted, and what the meaning behind it is. Matt Brill, who covers all things rates, all things fixed income, head of North America Investment Grade and senior portfolio manager at Invesco. Matt, how much are you looking at this yield curve and getting a little uncomfortable with its inversion, given the optimism that you're seeing in earnings and in certainly the credit space as well as stocks?
Yeah, good morning, Lisa. It's been a really interesting time for rates, and it's always funny to me when our traders refer to days like today as seeing more curve flattening, and I'm saying, well, is it actually flattening, or are we just more inverting? Because at this point, when you're already negative, you're actually not flattening. You're going even more negative. So when I look at the rates curve, it's telling you that over the near period of time, the Fed has got more work to do, but longer period of time, people believe the Fed is going to get things done, and you're going to see 10-year Treasuries kind of stay anchored around this high twos. Anytime we get to 3%, we feel like it's a good period to be buying. Overall, the economy is still actually doing pretty good. The numbers you saw on Friday were good. And the big question right now is always, is good? And I think absolutely, right? Right now, for the credit market, good is good. And we did not want to see jobs falling off a cliff. We didn't want to see the economy falling apart. And we got a really good number Friday, which makes us feel actually pretty good about things.
So what gives people conviction that we're going to get back down to 2% so quickly, which is what you're seeing in Fed funds futures and what you're seeing at least in interest rate swaps down the line? How much do you have conviction that they will do that without crashing the economy, basically the underpinnings of why credit is holding in and rallying to such a huge degree?
Yeah, so we're seeing some interesting things, particularly from corporations, that you would normally expect them to just start pulling back right now, start cutting jobs, stop investing. But we're actually seeing corporations invest. CapEx in certain particular places is going up. So you're seeing spending on inventory management. You're seeing spending on supply chain. You're seeing spending on renewables and batteries and things like that. So there's a lot of different ways that companies are spending money, which is good. Because otherwise you would start to feel as if like this inflation was just going to be just a complete, a very difficult time for them to overcome. But they're spending money to get down costs. And once this eventually takes place, that's going to flow through. And it's going to be good for the longer term for overall inflation. And we do feel like the Fed is going to be aggressive. They're going to be ahead of this. The economy is going to slow, but it's not going to slow so much that you're just going to see demand fall off a cliff. You're going to see more of the supply get more back in balance with the overall demand.
On the subject of supply, what are your expectations for issuance as we move through the rest of the year, Matt?
So corporate issuance has been really, really strong in investment grade over the last month or so. It's been basically non-existent in high yield. Just last week on Thursday, we had the big Meta deal out in the U.S. investment grade market, the first time that they issued. They issued $10 billion. There's over $30 billion in demand. So you get a new name, highly rated name, did very, very well from a demand standpoint. The high yield market, the supply in the high yield market is off about 70% year to date. So it's been basically closed. We did see 2 deals at the end of last week, chartered another one. So maybe we're starting to see things thaw out there. There is enough demand now, I believe, to start seeing deals come in the high yield market. On the investment grade side of things, it's been mainly the banks. The banks continue to come and really have been flooding the market, which is providing some interesting value. It's been a bit of a value trap all year long because they keep issuing more. But overall, I would say at some point, the banks are going to run out of having to issue, and you should start to see credit spreads there firm up.
Okay, and final question, just as we kind of talk about a Fed that you say is going to continue to be aggressive, the specter of a recession coming down the line, is that going to bring defaults this cycle, or do you think the risk of that is relatively low given the position of strength we were coming from?
So I think we're not going to be seeing significant defaults. We're really not going to see any downgrades probably till the early part of 2023. And that comes back to my statement of earlier of good is good. Companies don't default because there's too much employment. That just doesn't happen. So we're in a period of time where, yes, it's not Goldilocks. You'd prefer to see wage inflation be a little less. But as corporations are investing, as corporations are hiring, that's not going to lead to defaults. Yeah. Now, if energy were to completely fall over, that'd be another story. But we're at a much better spot in energy than we were back in 2015 and 2018 as well.
Matt Brill, thank you so much. I greatly appreciate that. This morning. Matt Brill's with Invesco. Thank you again. Lisa, this is below the headlines, but it's really important for the Apple community. Our Mark Gurman owns the high ground on reporting the tone, and he has an absolute tour de force in his message, which has gone viral this morning in technology. Lisa, just to the chase of the 2 brats, children at the Abramo house. The new iWatch is scheduled for September. Okay, I think that's the news you and I need to know.
If they're watching this, just mute it right now.
The new iWatch is September, and there's iOS, iPad. But in here, Lisa, is something really important. Gurman's got all his radar up on a thing called Stage Manager. This is a mystery. Stage Manager is a huge mystery in the Apple Q3, Q4, and that this is a software compendium that is, to be polite, problematic. That's the first I've heard of it.
Stage manager. Maybe it'll be a surveillance stage manager. Will be a little iWatch.
He doesn't mince words. He says this thing is challenged. They're struggling.
Well, this is the question, right? How much is some of the softening that we've seen in certain sales that Apple has produced, how much is that driven by certain models that haven't been as popular versus a secular slowdown in those purchases? They've held up really well. They've beat expectations, but that sale in China where they cut prices on certain products was really noteworthy for that very question. So how much are future products going to be able to be the home runs that previous ones have?
Do a data check here. You need to know oil south, 88.27 on West Texas Intermediate. We need to do the equity market, green on the screen. Bramo's gone long, futures up 24, Dow futures up 151. We got a 0.7% up move on NASDAQ 100, the VIX 21.49. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Senate has passed a landmark tax, climate and healthcare bill giving President Biden a victory on his domestic agenda. Still, the measure is a shadow of the $10 trillion plan that progressives had hoped for more than a year ago. The bill now goes to the House, where the Democratic majority is expected to pass it on Friday. A surprise change at the top of private equity giant Carlyle Group. CEO Koo-Sung Lee has stepped down. Lee's 5-year employment contract was due to expire at the end of the year. Bloomberg's learned that Lee and Carlyle's board had clashed over the contract in recent discussions. The firm's co-founder Bill Conway will step in as interim CEO. Hong Kong has reduced the amount of time travelers entering the city must spend in hotel quarantine from 7 days to 3. That's a greater than expected easing of its strict travel curbs, but Hong Kong is still an outlier in a world that's mostly reverted to pre-pandemic movement. Pfizer has agreed to buy Global Blood Therapeutics in a deal valued at about $5.4 billion. That will give Pfizer one of the few approved treatments for sickle cell disease. The disorder affects 20 million people globally, including many who are Black. Whirlpool will buy Emerson Electric's waste disposal business in a $3 billion transaction. The business, known as Incinerator, makes garbage disposal products, instant hot water taps and water filters. Whirlpool said last month that demand for appliances has dipped and would likely remain suppressed through this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Seeing wage inflation unambiguously after this number, accelerating after this number, after the ECI, after the Atlanta Fed. We have, by every reasonable measure of core inflation, inflation running somewhere plus or minus 5%.
The path from 9% down to the mystery of a 2% when Lawrence Summers there, the former Treasury Secretary of the United States, president of Harvard, I should mention as well, a modest acquaintance with economics, and talking there about the glide path and what do we do at pick your number, 5% or 6%, et cetera. Lisa Abramowicz and Tom Keene, Jonathan Ferro off today. I guess to the end of the week. I thought it was just a one-day hauls, but what do I know? Kaylee Line's with us as well. And right now we're going to recalibrate into the Wednesday inflation report with Dana Peterson. She's chief economist at the Conference Board, with all of the ability of the Conference Board to look at a different set of data out there. And I want to go, Dana, I know Lisa's really focused on a job-full economy, but I want to go to your call for restriction by the Fed after Jackson Hole. Are we going to calibrate for September 1 after Jackson Hole? Do we just need to get to Wyoming before we can look to the Fed meeting?
Well, Wyoming certainly is beautiful, but I think that the Fed is certainly data dependent. We're going to get several more readings on inflation, another jobs report, certainly updates on GDP. And I think the Fed is going to be looking at all of these indicators to determine whether or not it needs to go another 75 basis points or 50 basis points. But I think whatever it is, the Fed is going to continue to raise interest rates to really arrest inflation.
I mean, let's do the math here. If it's 175 beat move, or it's 250 beat moves, which is a stick, I get it. But what's a so what? Whether it's one move or two moves is a precursor to restriction. Does it matter?
Well, I think, just getting above 3% on the Fed funds rate, that's restriction. And, we can sit around and argue about it, but I think the fact
we don't do that on surveillance.
The fact that the Fed's been raising rates this aggressively, this quickly, it certainly is going to feel restrictive. We're already seeing that show up in the GDP data.
Dana, do you buy the data that we get on Friday? We heard Peter Scheer just earlier saying that the data doesn't seem to cohere with some of the granular, on-the-ground, specific inputs. So do you think that it's going to get revised a lot lower and it's going to give a less rosy picture of the labor market?
Well, how much can you revise down? That was an astounding number. More than 500,000 jobs added in July. That would be a huge downward revision. And whatever the revisions are, they're probably going to be minor. What the labor market's telling us is that we still have a very strong labor market. Many people are seeing their wages rise. Many people are being hired, especially in those in-person services that struggle to find workers. It's really astounding what we're seeing. And I don't think that the numbers are lying to us.
So let's talk about what we heard from Peter Bukvar, which I thought was really fascinating that Tom brought up, that people are overhiring and companies are scarred by what happened post-pandemic when they fired a lot of people and then had to bring on staff that just was not there. How much is that going to be a persistent theme throughout whatever happens in this next cycle?
We think that labor shortages are here to stay. A lot of it's demographic. You have more people retiring from the labor market than you do young people available to refill those jobs. We also have very strict immigration policies in the U.S. That makes it very difficult to find labor from outside of the country. And still, you have many people who are challenged with childcare issues. Many people don't want to work 2 and 3 jobs. That's why they're trying to find higher wage jobs. We think that this is just going to be an issue even beyond what we're thinking is going to be a brief recession in the U.S.
Okay, so what does that mean for how persistent upward pressure on wages is likely to be?
Well, certainly if inflation continues to be elevated and the Fed struggles to get back down to the 2% inflation target, we think that there's probably the potential for a wage price spiral. Already, if you match up the PCE deflator with the ECI, they're both moving together. And that's really a challenge that the Fed is trying to prevent from happening with its actions.
But obviously, its actions have a lagged effect. It takes a while for us to see the real impact of it, as evidenced by how strong the payrolls report was on Friday. So can the Fed act quickly enough that they are actually going to be able to lasso that and get that under control? Or are we going to be looking at a situation where this actually does end up eventually out of the Federal Reserve's hands?
Well, I think the Fed is acting as quickly as it can. I mean, other than raising rates every month, certainly at every meeting since March, they've raised interest rates, and I think the Fed's doing what it can. But as you said, monetary policy comes with a lagged effect. First, you're going to see the effects on things like mortgage rates and the housing market, and then consumer spending, and then inflation. And so it's going to take some time, but we feel that the Fed can probably do its job and get things done in terms of bringing down inflation.
Dana, does any measurement of housing rent or ownership get in the way of their plan? I mean, can housing be such a crisis, so expensive, so persistent, that it just gets in the way of their best outcomes?
Well, surely housing is a huge driver of inflation right now for consumers in the U.S. And certainly as long as home prices, the valuations of new and existing homes continue to rise, that's going to show up in the OER and in rents with a lag, of course. And so that really does present a challenge for the Fed.
Dana, I got to leave it there. Dana Peterson, thank you so much. Greatly appreciate it with the conference board. Lisa, I featured this last week. To me, it's a single biggest issue. It's not about the haves and the have-nots. It's about both. It's about where do you put your bedroom? Where do you put your living room? Where are you going to live? And it's a national crisis.
We saw prices of homes climb substantially. They're starting to cool off, but there's a lag effect for how long it takes for that to trickle out into rents. And the more unaffordable house prices have gotten, especially with mortgage rates where they are, the more people want to rent, which is the reason why they can continue getting pushed up further and further before reaching that breaking point. And you're seeing that not just in places like New York City, but all around the country.
I mean, Kaylee, I'm looking at the bank rate here, and I guess it's come in, but I'm sorry, we were at 4% in February, up to 6%, and we've pulled back mightily to 5.6%. That doesn't get it done.
Yeah, and it's still significantly higher than if you were looking to buy a house 6 months ago. It comes back to the affordability problem. And as we have that conversation with Dana about wages, people demanding higher wages, people aren't earning enough to keep up with inflation, even with the wage gains we are seeing. And at what point, obviously, you're starting to see that showing up in housing data, but what point does that start showing up in everything else? People just not being as tolerant for the higher prices that they're facing.
I'm sorry, it's a round number. The NASDAQ is up 100 points. 13,000. It's not like Dow points. It's not like the Dow Jones Industrial Average.
How much is the Dow up, Tom?
It's up. The Dow is up 141. I mean, I'm sorry. I'm not in it. It's a bull market. This is Bloomberg. Bloomberg Surveillance, it's Abramo bull market. Lisa Abramowicz with us to give us team coverage here with NASDAQ futures now up 0.8%. I'm sorry, Lisa, it's a melt-up. Ferro would say, it's a melt-up, Tom.
Is that your European accent? That's your British accent.
That's my British accent,
oh, my
close as I
goodness.
get.
Okay, so you can write in about his Marmite references in British accent. But yes, I would say...
It's a melt-up.
It's a melt-up. I would say that this is a persistent increase in terms of valuations despite all the gloom. Mike Wilson, but also Goldman Sachs tax analysts coming out and saying that profit margins are going to get squeezed. Still, you're seeing the S&P up 0.6%, NASDAQ up 0.8%, even with 2-year yields climbing so significantly and climbing so significantly past the 10-year yield.
Kayla Lines, Joe Weisenthal emails in. He goes, hey, stupid, West Texas under 88. I mean, that gets your attention. 87 is not $88 a barrel.
Absolutely does, especially when you see gas prices coming down in the United States for, 50 days now, Tom? Obviously, that politically helps the Biden administration. The question is, how sustainable is it when we had people telling us earlier that oil is going to go back up to $120 a barrel because supply is still so constrained? That's the question.
Futures up 26. It's always an important conversation with Libby Cantrell, head of public policy strategy at PIMCO. But this morning, after historic legislation, it's really critical as well. We're thrilled Libby Cantrell could join us here at our world headquarters. Libby, I want to cut to the chase. How do you put into process the legislation of thousands of pages?
Well, that's a good question. Fortunately, Washington is quite expert at doing that. Most bills tend to be hundreds, if not thousands, of pages. But I think that what this sort of underscores how quickly this bill was able to come together to be passed by the Senate, will be passed by the House later this week, and then promptly signed into law, is that many of these ideas, Tom, have actually been percolating in Washington for years. Take the drug pricing in terms of allowing Medicare to negotiate drug prices with pharma. That is a concept that literally has been percolating since I was on the Hill back in 2003. So in some ways, many of these ideas, again, have already been in text, were able to be put into legislation immediately. The big question, of course, was just to get that unanimity among those 50 senators on the Democratic side.
The question I asked our Jack Fitzpatrick, can the Republicans take it away if they win the House and the Senate?
Can they take it away? It will be very difficult, and I think what you've seen even with the Trump tax cuts is it's very difficult to take things away, to take benefits away, particularly on something like the drug pricing for Medicare. That's something that polls incredibly well. More than 80% of Americans support that provision. Older people tend to vote. So particularly for that, difficult to take away. And then on the climate piece, and as a reminder, $400 billion of tax incentives for production and for consumption on the sort of the clean energy tax front. All of that, pretty difficult to take away as well. And most of those last for 10 years.
And Lisa, I looked at the Medicare-Medicaid combination for federal budget. Thank you, Robert Jameson, for helping out of Washington. And not out of 65 and LBJ, but roughly Nixon, we've gone from 1% of GDP out, really approaching 6% of GDP for those two programs.
I did not know that. That's really fascinating, and a reason why this has been such a big issue. And of course, I looked at the pharmaceutical companies' shares ahead of the open, thinking that they'd be tanking because they were going to get less income from Medicare. They are not, Libby, which raises a question about what the tangible effect on investment will be from this bill. If even, you had David Sowerby on earlier decrying some of the concerns about the taxes on buybacks, share purchases, as well as that minimum corporate tax imposed. Is there a corporate read-through that is not getting priced in, or is this not as significant a move in terms of crimping profits, as some would say?
Yeah, so Lisa, on your point about the pharma companies, they actually got a little bit of a lifeline over the weekend because one of the bigger provisions that was in the bill that would have required that pharmaceutical companies negotiate with private insurers on the pharma prices actually got stripped out of the bill because of some parliamentary mumbo jumbo, didn't qualify for the so-called reconciliation bill. So that's maybe why you're actually seeing a little bit of support in those names this morning. But overall, I don't think we should overstate the impact of this bill. I think invariably there will be winners and losers. Losers like the pharmaceutical industry, because some of those provisions obviously still persisted. Technology, some of the companies that have been able to take advantage of this sort of book income, corporate tax rate sort of arbitrage will also be losers. And then, big winners, obviously renewables, which are really priced in. So I think sort of the macro impact or even the sector impact has likely been pretty much priced in here. But overall, in sort of my world, the political impact, I don't think has actually been priced in. I think this is a huge boon for Democrats who really needed it, right? The price of gas, Biden's disapproval ratings, the generic ballot, all have been major headwinds for the Democrats going into the midterms. And here they are. Here they are able to go in at sort of the 11th hour and really campaign on the fact that they can govern and that they can get a big piece of their agenda that they campaigned on in 2020 through, which was the climate piece.
So, Libby, what is the market read-through in terms of if the Democrats keep the Senate, if the Democrats don't lose as much of the House, which seems to be the feeling that's increasingly getting speculated upon?
Yeah, so I think, Lisa, the conventional wisdom that the Democrats will lose the House is probably right if you look at history, right? Since World War II, the party in power has lost an average of 25 seats in the House. So just if past is prologue, Democrats face an uphill battle. But the margins there do count. You know, I think our view is that they could lose maybe as little, as few as 10 seats or as many as 50 seats, sort of depending on voter enthusiasm and what's actually happening in sort of October and to the buildup of November. And that margin does matter because in the long term, because that means if they lose fewer seats, then they're going to be able to more likely recapture the House in 2024. On the Senate, though, and we've been saying this for a while, it's much more of a jump ball. The Senate tends to not be as much of a national election because, of course, only a third of the Senate seats are up for re-election. Republicans have actually a more difficult map this cycle, and some of the candidates that are running on the Republican ticket in battleground states like Georgia and Pennsylvania, maybe even in Ohio, are sort of less experienced, more green, and as a result, maybe have less of a chance to win. Even when the national mood is really much more supportive for Republicans. So I think bottom line here is the House is likely lost for Democrats, at least at this point, but the margin does matter. The Senate, much more of a jump ball. Lastly, in terms of the sort of the policy implications, though, as long as Republicans take back just one chamber, that means that Biden's legislative agenda for the next 2 years is likely, dead or at least on ice for a bit. There's still some chance of bipartisan legislation around tech and some other areas, but probably on ice. So that really is, for the market's perspective, what people will be really focused on. But again, folks like me are focusing a little bit on the longer term and sort of the read-through for 2024 in particular.
Well, Libby, you mentioned voter enthusiasm a moment ago. I'm wondering if there's a lesson to be learned from Kansas and the abortion vote there, the turnout that we saw. Is there an underestimation of the galvanizing effect that some of the social issues like abortion may actually have on voters approaching the midterm beyond just kind of the macroeconomic environment?
Yeah, again, and this is, again, another piece of good news that the Democrats have had over the last several weeks. Of course, voter turnout in Kansas much higher than expected. That ballot initiative lost by almost 20 points. Now, there are some idiosyncrasies that I think are maybe difficult to extrapolate from Kansas sort of nationally. But I think it is, I think that for Democrats, their big takeaway is that this is a galvanizing issue. Now, one important distinction, of course, is that was a particular issue that was on the ballot versus just, the midterm elections, which are more general, where candidates are on the ballot.
Quickly, and this is completely unfair, but it's Unfair Monday here, we have this ginormous legislation. Is this the window for President Biden to say he's a one-term president?
I highly doubt he will do that. Yeah. I mean, theoretically, sure. I think he will not do that, especially before the midterms. But I think, Tom, it's a good point in that he will likely have to decide whether he really is going to run for 2024 shortly thereafter. Remember that in the debates start in June of next year. So we actually need to have a pretty good idea.
Can't we be like the British? Where the hell is Pharaoh? Get Pharaoh back.
He's not going to come back if you make that British accent again.
That old republic.
Lisa, come on. The British, they get it done, Sunak, Truss, and all that. And Libby's depressing me with debate. The debate started in June.
Yes. Well, if 2019 were any.
How many people will be on stage? Like
who
42
knows?
people?
Well, look, I think if President Biden does not win, that we are going to see a very kind of open and potentially kind of messy and raucous primary on the Democratic side, and the same thing on the Republican
Oh,
side.
last time wasn't raucous.
No,
enough.
exactly. I think that will be the last time it was just on one
The
side,
British
right?
do it so. Come on, the British do it so
I know.
much
Well, it's also a
better.
parliamentary system, Tom. You know that. I mean, this is different.
I do. It's a what?
A parliamentary
Tom knows
system.
a lot of things
you know?
that he likes to
Yeah.
I did not know that. Thank you, Elizabeth Cantrell. Greatly appreciate that. So at least
Dropping
I'm
the
learning.
knowledge here.
It's not it's a parliamentary system.
So you want a road trip to London?
I
That's
think we
basically
need.
what
So I
I
get a
hear.
civics
Let's go back,
lesson
talk
from
about
Ferro.
the parliamentary situation in Marmite.
Let's go to the Let's go to the I'm saying let's go to the Marmite here. Let's go to the market. I'm sorry, Lisa. The biggest story today is a negative 44 beeps inversion on the 210. I mean, it's screaming the way it's going towards 50 basis points.
We've just gone straight through Priya Misra's call for 40 basis point inversion, and you've seen that 2-year yield continue to climb and that 10-year yield continue to go lower, at least on a relative basis. We'll be talking about that coming up on the open with Michael Kushma, Global Fixed Income CIO at Morgan Stanley. We also have a host of other guests, including Stuart Kaiser.
You're leaving
of UBS.
now to go to your other property?
Yeah, it's John Farrow's. I'm renting it while he's off in Capri.
Well, thank you, Lisa.
Airbnb-ing the open.
Yeah.
Well, you'll be back tomorrow. That'll be wonderful. Kaylee Lyons and Tom Keene and Bramo as well. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden and his party finally got the win they've been waiting for. The Senate passed the Democrats' landmark tax, climate and healthcare bill. The House is expected to pass the measure on Friday. It's a slimmed-down version of the $10 trillion plan that progressives had sought more than a year ago. Now the question is whether it can give Democrats a boost going into November's congressional elections. China signaled that military activity around Taiwan was continuing past those drills announced in the wake of House Speaker Nancy Pelosi's visit. The Chinese military says it conducted anti-submarine and naval strike exercises today. The recent maneuvers near Taiwan have been the most provocative in decades. And Russia has told diplomats it's ready to welcome international monitors into a Ukrainian nuclear power plant that came under attack last week. United Nations atomic inspectors have said there's a very real risk of a nuclear disaster at the plant. Ukraine still believes there are around 500 Russian soldiers in and around the site. And the biggest U.S. meat companies getting hit by inflation that's hurting sales of beef and chicken. Tyson Foods reported quarterly earnings that missed estimates. The company says higher prices are leading shoppers to trade down to cheaper cuts and to limit visits to restaurants. And SoftBank CEO Masayoshi Son is promising there will be widespread cost-cutting after a record $23.4 billion loss. The Tokyo-based company lost the vast amount of that money in its Vision Fund investment arm, which marked down the value of holdings such as DoorDash and Coupang. SoftBank has also lost more than $6 billion because of the weaker yen. Global news 24 hours a day, on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Yes, headline inflation will be falling, primarily because energy prices coming down. But core inflation that really represents how tight the domestic economy is still rising. And don't think we've reached the peak in that.
Ellen Zentner, fascinating with Morgan Stanley, dovetailing the caution of Mike Wilson and her measurement of the American economy, not destroyed, but everyone would pause Friday for a jobs report. Lisa, we haven't talked enough about that right now. I mean, I'm sorry. 500 whatever thousand was a wow. Excuse me, Kaylee. I'm sorry. Kaylee, I'm just frazzled here this morning. Ferro, one-day trip, and I'm just falling apart. Kaylee, 500,000 plus is a wow statistic.
It was. It blew past expectations. You also had wage growth that came in higher than expected, Tom. That is a strong labor market that, in theory, gives the Federal Reserve clearance to be as aggressive as it says it is going to be to get inflation down, making the read we get on Wednesday and CPI, core in particular, all the more crucial. I don't even know why we're here today, Tom, or tomorrow. We should just come in on Wednesday at 8:30.
Yeah, I think it's been interesting. And again, a little Merger Monday theme going on as well as people, CFOs and such, look at a set of smaller transactions. Right now, a bigger transaction and I mean a larger transaction, has been the immense. Well, let's stop right now. We've got the president here at Rehoboth after COVID, where he and Dr. Biden are getting on Marine One, and they will go up Delaware Bay, and they will move from Rehoboth up to Dover Air Force Base for a somber trip to Kentucky, all the challenges that they've seen in Kentucky and flooding here. Maybe Senator McConnell there after this important legislation will greet the president. We'll have to see for that as well. The president on Marine One in Delaware. Right now, not on Marine One, but someone looking at the strong dollar that can afford Marine One is Dara Meyer, head of research and FX strategy at HSBC. And I will not mince words. HSBC with absolute leadership on strong dollar and resilient dollar in the last number of years. When does the dollar give it up?
Not yet. And it's interesting. There's been a few times, hasn't there, where people have tried to call peak inflation, peak economy in the US, and therefore peak dollar. And they got it wrong on Friday. They might get it wrong again this Wednesday around US CPI. But everything we're hearing from the Fed is be patient. We want to see the numbers on inflation. We need them to come down. So, I think they're calling it early.
Lisa Cayley's got some important questions here, but what I would really want to focus on is the effect of this resilient dollar on EM. HSBC out of Hong Kong has a huge view of EM. How does EM survive a resilient or even stronger dollar?
This is a really tricky environment for EM because you've got that strong dollar, you've got a Fed tightening, and you've also got a global economic slowdown. A lot of the time in the past, we've seen the Fed tighten into economic strength, not into global economic weakness. So this is a really problematic mix for emerging market currencies. You can't find a couple of local winners, but as a universe, it's that's a very tricky environment for that.
Lisa Cayley, to me, this is why Damian Sassower is so important right now. I really can't say enough about it.
Yeah, his work over at Bloomberg Intelligence is definitely crucial coverage at this moment, Tom. Lisa Cayley, I'm enjoying my new name. Dara, when we talk about the dollar, is it so much dollar strength or weakness of everything else that is the backbone of your call?
That's a really good question.
Yeah, well, it feels like it's all about the dollar, doesn't it? Every conversation we have about currencies, with the odd exception, Bank of England creeps in, the ECB creeps in, but we always come back to the Fed. We come back to non-farmers. We come back to US CPI. So to that extent, I think the dollar is at the core of the FX call. The second thing, and I think this is something people are making a mistake about, is the dollar is at the core of the call, but that doesn't mean the US economy of itself is at the core of the call, because we have to think about what's happening to economic growth outside of the US, what's happening to real incomes outside of the US. And it's that global slowdown that is supporting the dollar despite the fact that the US economy is slowing as well. And that's the mistake dollar bears have been making. They've been saying, hey, the US economy is going to slow, the Fed are going to have to slow, the dollar is going to slow. But the reality is the dollar does well when the global economy is under pressure.
Well, and of course, one of those economies under pressure is really the Eurozone and the UK as well. You mentioned the BOE and the ECB. Realistically, any hikes from those central banks, can they be supportive of the currency if they're hiking into substantial weakness?
Well, answer to the first question is yes. I think we will get more hikes. I think they recognize they have to do something to bring inflation lower. But does that translate in the traditional way to a currency positive? I'd say no, because as you point out, they're doing it into economic weakness. What I actually like about the Bank of England, frankly, though, is I think they've kind of come clean in saying, look, if we want to get inflation lower, a likely side effect of that is an unpleasant one. It's going to be a prolonged recession. Everyone else in G10 is telling us, hey, we're going to navigate inflation lower. We're going to do it with the soft landing. Please don't worry. I mean, maybe that's the right thing to say, but everyone's saying it's a narrow path, but everyone's forecasting they're going to land this narrow path. So I think kudos to Bank of England to my mind for coming clean. It's not going to help sterling, of course,
right?
But I think it sets up expectations perhaps more realistically.
Yeah, at least they're being honest. So we've obviously already seen parity on euro dollar. Do you think realistically we could see it on the cable rate?
I don't think we'll get quite that low. Much as I'd love to, because I'm paid in dollars and I've got kids in the UK, but it's not going to quite play out that generously for me. The dollar is overvalued, or at least it's rich against a number of currencies. Euro, I think we can go sub parity 95 cents without that valuation elastic band being particularly unpleasant. But to talk about parity against cable, that would be a big stretch. Maybe a 115, 116 is plausible, but I don't think we'll go a great deal further than that, bar some calamity.
The difference in this conversation is we're freely floating. back to the crises of the 90s, except the yuan is not. Is renminbi freely floating within its band, or is it fixed within its band?
It's a teenager. And let me explain. You've got a teenage daughter. So, you know.
Quick, where's my pen? I'm taking notes here, Dara.
You know, China wants to have a fully freely floating currency, a liberalized, internationalized currency. And so like a teenager, you want to let it get out in the world and experience the world. But if it misbehaves.
Right. When are you leaving?
If they misbehave, they will ground it. You know, and that's what happens. So if you get the currency market to their mind misbehaving, then they massage, then they nudge, and then they ground the currency. I would say for the most part, renminbi of late has been kind of left to its own devices. And I think it's been behaving. And it's been important because it has been a somewhat helpful anchor in the Asia context, at least. But, you know, I think maybe we expect a little bit more of the Chinese economy. Do you remember 3 months ago, a lot of talk about a second half acceleration, policy-led, and that's kind of...
Is it just delayed? I mean, where do you and HSBC, very quickly here, where do you and HSBC frame where China not gets escape velocity, but at least moves the vector around on GDP growth?
Well, I think it's happening in a small way already, but it's less kind of big scale than people might have anticipated. It's very targeted easing, and so we're not kind of getting that big showpiece of, right, okay, here's the big stimulus. And the problem, of course, we're not getting that, but we are getting this continual erosion of growth expectations elsewhere in the globe. So net, everything's kind of feels like it's tracking lower.
Me, Kaylee, Lisa, John, I mean, the Mandarin, I mean, in Hong Kong with the HSBC team, this could work, right? In Hong Kong?
I think, look, that could be the dream team. Could be the dream team.
You know, Steve Major, Dara Mayer, and the rest here at the Mandarin in Hong Kong. Kaylee, I think it works.
All right, road trip.
Captain's Bar. Here we come.
Got that right. Dara Mayer, thank you so much. With HSBC Futures Advance up 27. Good morning.